Yes, good morning, everybody. So welcome to the day 2 of our CA final marathon. So we've lost already some time due to our technical issue. So let's not waste any more time. So let's dive into the topic right away. So for the first session, we'll be taking up with one of the big ticket topic, that is financial instrument. So let's go through or revise this particular topic with the help of our chart book itself. One, financial instrument means it's a contract that either creates a financial asset to one entity or financial liability or equity to another entity. It's basically a contract which creates either a financial asset to one entity or financial liability or equity to another entity. So if you want to call it as financial instrument, it should arise as part of contract. Okay. So now your income tax obligations, etc., that you pay to the government, no, it doesn't arise as part of contract. It's a statutory obligation. It's not a contractual obligation. Hence, those are not your financial instruments. Okay. Now, financial instrument means it's either financial asset or financial liability or equity. So let's understand the components a little better one by one. What does financial asset mean? Financial asset means, or if I have to go one step back, why this particular standard was introduced. In fact, this is the topic name. Into this, you will have various standards. Ind AS 32, 109, 107. Like this, you have 3 standards coming under Ind AS or financial instrument wala topic. Why this standard was introduced was, so if I have to just give you a quick background. So if you visualize the balance sheet, on the balance sheet, I'm just showing the balance sheet in T format for simplicity. You have PP, you have intangible assets, correct? You have some investments and you have some current assets like cash, debtors, etc. Then on the other side, you have equity, share capital, reserves and surplus, etc. Yes, and non-current liabilities, current liabilities, etc. Now, if you just check, do we have any accounting standards which talks about equity, non-current liability, current assets, etc.? How to value them? Do we have any accounting standards? No. Hence, this particular standard was introduced, or this particular Ind AS was introduced, which talks about the valuation of these components, because even these components are very important. So to bring these components, the one which I've put a question mark on, so to bring those components under the standard, this particular topic of financial instrument was introduced. Okay. Now, so we know financial instrument means it's either a contract which creates either a financial asset to one entity or financial liability or equity to another entity. So what is financial asset? Financial asset means few components. One, cash including bank deposit is a financial asset, specifically included in definition. So this particular thing got covered. Cash and cash equivalents. Second one is equity instruments of another entity. If you have purchased equity shares of another company as an investment, that also will get covered under, or that is also a financial asset. 3, a contractual right to receive either cash or any other financial asset, like from debtors. If you have sold the goods, you have a contractual right to receive cash. So the third example is talking about your debtors, bill receivable, etc. So if you have a contractual right to receive either cash or any other asset for that matter, that is also financial asset. Or contractual right to exchange financial asset with financial liability under favorable condition. So what does this mean? So let's say we have to pay the creditor 10,000 rupees. Okay, so we have a bill receivable worth 9,000 rupees. We have to pay the creditor 10,000. We have bill receivable worth 9,000. We told the creditor, we don't have money right now, but I have an asset called bill receivable. Can I give it to you? Creditor told, no problem, give it. We told that bill receivable is only worth 9,000. Okay, but creditor told, no problem, give it. That means what? I am settling one liability of 10,000 by giving away an asset worth 9,000. That means this is unfavorable for me or favorable for me? Favorable. So if you are making any such contract to exchange financial asset and financial liability under favorable condition, meaning under gain scenario, that is also, or such a contract is also a financial asset. Okay, the last one is a derivative. Derivative could either be a financial asset or a financial liability. We'll talk about derivative as a separate topic at the end. For now, let's leave out the derivative part. Okay, so this is about financial asset. All right. Okay, what is it again? Financial asset means cash including bank deposits, equity instruments of another entity, contractual right to receive either cash or any other financial asset, or to exchange financial asset and financial liability under favorable condition. Fifth one is derivatives. All right. On the same line, you can also build financial liability ka definition or financial liability ka components is one. First was what? Cash there in the contract in financial asset wala definition. Cut out that. Then it was equity instrument. Cut out that. What is the third one? The third one there here was contractual right to receive cash. In asset, you have a right to receive cash. In liability, you have an obligation to pay cash. So the component will be, so it's a contractual obligation to pay cash or any other financial asset. That is the first feature of financial liability. Or to exchange financial asset and financial liability under unfavorable condition. Meaning, same example, I have creditor, I have to pay him 10,000. Okay. I did not pay cash to creditor. I gave away bill. I gave away bill receivable, my asset. But that bill receivable ka value is now 11,000. So to settle 10,000 worth of liability, we are giving an asset worth 11,000. That means this is unfavorable or loss scenario for me. Such a contract is also a financial liability. Okay. Or a derivative or a non-derivative contract to settle variable number of equity shares. If company is issuing their own equity shares, that is also financial liability. So if company issues their own equity shares, it is share capital. No. For you to classify it as share capital, there is some test. If those test is not paid, if the test is not fulfilled, then you will classify it as financial liability. This in a bit I'll tell you in the next section. Okay. So this is about financial liability. So we covered two components: financial asset, financial liability. What is another one? Equity. Okay. What does equity mean? Equity shares are basically an instrument which gives the holder right over net assets of the company. If you buy equity shares of another company, then you have a right over not the assets of the company. You have a right over their net assets. Meaning after paying off all the liability holders, if any asset remains, that asset will be given off to the equity shareholders. So that is what is equity ka definition. And the moment a company has issued equity shares, if a company has issued equity shares, that company, do they have any obligation? No. Equity shares are permanent capital. Once a company issues equity shares, they don't have any obligation to repay dividend, nor do they have any obligation to repay the capital back. That means in case of equity shares, there is no contractual obligation to pay cash. Okay. Normally, equity shares we say is non-puttable. Hang on to this term in a bit. Okay. All right. Fair enough, people. So I told you, sir, if you want to classify it as equity, there are some tests to be satisfied. In fact, to be more specific, we need two tests. If both the tests are satisfied, then only you can call it as equity. That we call it as fixed to fixed test. We call that as fixed to fixed test. If both these tests are satisfied, then only we can classify an instrument as equity. If the test passes means you will account it as, if this test passes means you will account it as equity. If this test fails means you will account it as a financial liability. Hence in financial liability also equity component has been brought in. So when can we say it passes, sir? Or what does this fixed to fixed test mean? Sir, simple. Fixed to fixed test means what? One, the number of shares. How many number of equity shares have been issued should be fixed. Company is issuing how many shares? No, should be fixed. And how much money they will receive by issuing equity shares, that is also should be fixed. That is what we mean by fixed to fixed test. How many shares you are issuing should be fixed, and how much amount you will receive by issuing those equity shares, that should also be fixed. If both of this is fixed, then we say fixed to fixed test is passed and we classify that instrument as equity, meaning we show it as equity share capital. Otherwise, we will show it as a financial liability. That's what we're talking about it here. Okay. However, there are certain exceptions. Even if fixed to fixed test fails, or if the number of shares varies due to time or due to bonus shares and all, still we say the classification is equity only. Like, to give you an example, so let's say we have convertible preference shares. We have issued 1 lakh convertible preference shares. Convertible preference shares means, let's say we have issued convertible preference shares worth 10 lakh. Number of convertible preference shares is 1 lakh. Okay. Total money received is 10 lakh. So convertible preference shares means, are we going to repay this 10 lakh back to preference shareholders by cash? No. We're going to convert it into equity shares. All right. We told this preference shareholders, if we convert within 1 year, we will give you 50,000 shares. If we convert by the end of second year, we will give you 75,000 shares. If we convert by the end of third year, we will give you 1 lakh equity shares. That means number of equity shares is fixed or varying. It is varying, but it is varying due to time. So even if it varies due to time, still the classification, this convertible preference shares will be shown in your balance sheet as equity itself and not financial liability. That is what I've written it over here. Okay, sir. So this is about financial instrument ka definition, or financial asset, financial liability and equity ka definition. One pointer we saw here was equity shares are generally non-puttable. What does this mean? So let's look at puttable instrument. Or all this can come as a 2-marker MCQ question. There are some good 8 to 10 marker question also, which we'll be covering with numericals. This I'll quickly run through as just an example and the wordings. Okay, we'll focus more towards problems because this is one chapter where you can expect some 2-3 good big questions to turn up. So we'll practice that. We'll quickly try to revise this. Okay, and as I told you yesterday, this revision will be helpful to you only if you have already prepared it once. So if you have not prepared for the first time you're coming and sitting, all this will kind of scare you because this is something which you already should know. Then only it will help with the revision. Okay, and that's one of the requirement. Yeah. Okay, so what does this puttable instrument means? Sir, if you have issued some puttable equity shares, in the problem they'll say a company has issued puttable equity instrument. What that means is, let's say X Limited, they've issued 1 lakh puttable instruments to Mr. Y, let's assume. They've issued 1 lakh puttable shares. What this means is, sir, if a company issues equity shares, the company, should they have to pay any dividend on that compulsorily? No. Should the company has to repay the equity share? Should company repay the equity shareholders their money? No. That means company will not have any obligation. But if company has issued puttable shares, then what puttable shares means? The holder of the instrument, who's holding that instrument now? Mr. Y. He has a right. He has a right to sell this 1 lakh shares back to the company and collect money. So if you have issued puttable instrument, what it means is it gives a right to the holder of the instrument to sell the shares back to the company and collect the money. Okay. So that means if he exercises this right, company has an obligation to pay cash. But on equity shares, we don't have obligation. That's the reason we say equity shares are generally non-puttable, because puttable shares has obligation attached and equity shares should not have any obligation. All right. But puttable shares also you can classify it as equity. If you issued puttable shares also, you can classify it as equity provided certain conditions are satisfied. What are those conditions? Like equity shareholders ka condition. This puttable shareholders should have a right only over net assets. Okay, they should have right over net assets, meaning after paying all the liability holders only, they should get back their money. And they should be subordinate to all the instrument, meaning all the liability holders should be first settled and then these guys should be settled. Okay, then it should have identical features. If you have issued multiple puttable shares, all of them should have same features. It can't have different features. On one puttable shares, you're issuing 10% dividend, another one 12% dividend. Like that, partiality is not acceptable. All of them should have the same features. Okay. So puttable shares means one obligation already company has. That is, if a holder has a right to sell, and holder, if he sells the shares, means company has to pay the money. So one obligation is already there. Other than this, extra obligation should not be there. Okay. So I will give you extra money. I will convert it like this. Extra biscuit should not be there. Only this normal obligation should be attached. No extra obligation should be attached. Okay. The last is the return on these puttable instruments should be based on net assets and net profit, because shareholders will get the dividend only if the company makes profit. So the return for these guys should be based on profit or changes in the net assets. So if all of them are satisfied, then puttable instrument can also be classified as equity. Otherwise, puttable instrument will be classified as financial liability. Okay. All right. Next, reclassification. Sir, can you change the classification from financial liability to equity? Yes. If let's say initially fixed to fixed test was not satisfied, for you to classify it as equity, fixed to fixed test has to be satisfied. If fixed to fixed test was not satisfied, it means the classification would have been financial liability in the first year. Let's say in the second year that fixed to fixed test passed. That means now you have to classify it as equity. So you have to move from financial liability to equity. So if you are shifting from financial liability to equity, obviously equity has no obligation. So you use what, sir? Whatever is the carrying amount of financial liability, same thing you show it as carrying amount of equity. Basically gain or loss is not required to be accounted, because there is no obligation to pay cash. However, if you are reclassifying from equity to financial liability means you have an obligation. That's the reason whenever you're doing this change, check on the day you're moving or the day you're shifting category, on that day you check what is the fair value. Okay. And classify this financial liability based on this fair value. So obviously there will be a difference between carrying amount and this fair value. The difference will be recognized in other equity or equity. Okay, sir. So this is about quick basic components. So now let's dive into the numerical part, or before that, I'll just tell you this part is a lot more important for examination from this topic. First, we already discussed financial assets, right? Now this particular standard, sir, it says if you have financial asset can be valued under 3 methods. The valuation of financial assets can be done under 3 methods. What are those 3 methods? ACM method or amortized cost method, FVT OCI method, that is fair value through other comprehensive income, FVTPL method, that is fair value through P&L account. So if you have financial asset, it can be valued under any of these 3 methods. Okay. Sir, anything can be followed, sir? No. Each of the method has some test or have some condition. If condition is satisfied, then you can follow the respective method. Like if you want to follow amortized cost method, then there is a 2 test, business model test and contractual cash flow test. Okay, what is this business model? First I'll tell and then give you a small example. So the business model test means the business model, if you want to follow ACM method, the business model is to hold the instrument till its maturity and collect all the contractual cash flows. You have to hold it till, here the business model will be HTM, meaning hold it till maturity and collect all the contractual cash flows. That is one. And the contractual cash flows, we say it should be SPPI, meaning sole payment of principal and interest. So whatever you are getting as cash flow, no, should only be principal and should only be interest and nothing else. So give us an example. Sir, there is one company X Limited. They have invested. Let's say they have invested in 10% bonds or 10% debentures. Okay, of let's say Z Limited. So X Limited has invested in some bonds of Z Limited. Okay, worth 10 lakh rupees, let's assume. All right. Now, for company issuing it, it's a liability. For the investor, it's an asset. No, because investor has a contractual right to receive cash. On this bond, X Limited has a contractual right to receive cash. That's the reason this is what? This investment in bonds for this X Limited is a financial asset. And financial asset, just now we discussed, either you can go for ACM method or FVT-OCI or FVTPL method. Now, if you want to go for ECM method, means what is it saying is, let's say, sir, this bond ka life is 10 years. This bond has a maturity period of 10 years. If you want to follow ACM method, then X Limited should have the intention to hold it till maturity. Till 10th year, X Limited should not sell off this investment. Till maturity, they should plan to hold this investment and collect all the contractual cash flows. So if the business model is to holding it till maturity, in my example, holding till maturity means investing or holding it till 10 years. Then we say business model test of ACM is passed. They're holding till maturity. And the other one is your contractual cash flow test. So here X Limited is an investor. Investor will get return. On this bond, what will the return the investor will get? Periodically, he'll get interest. And at the end of 10th year, he'll get principal back. That is what CCF test is saying. Whatever you get as return, no, should only be interest and principal. No other extra biscuit or goalie should be attached. Like sometimes company says, no, we will redeem we will convert your debentures into equity shares. All that extra biscuit they will give. All that should not be there. So cash flow should only represent interest and principal and nothing else. All right. So if this is satisfied, means you can go for ACM method. Okay, that is one. All right. So when can you go for FVT-OCI method now? Same. It also has a business model and CCF test. Same tests are there for here also. So what is the business model here is? Here the business model is, let's say same example, X Limited says, what is the maturity of this bond? 10 years. You asked X Limited, how long are you planning to hold this investment? They told, I'll hold it. If I get a good price, I will sell also. I'll hold it till 10 years if I want. Or if I get good price, let's say in the 4th year, 5th year, I may sell it off and buy something else. Okay, now means now what is the business model? Is a business model to hold till maturity? No. Business model may be to hold till maturity or maybe to sell also, right? So if the business model is to hold and sell the financial asset, if investment good opportunity arises means, then we say you cannot follow ACM method, you have to follow FVT-OCI method. Like that. Contractual cash flow test is same. Whatever you are getting as cash flow should represent sole payment of principal and interest, meaning you should only get principal and interest, nothing else. So that is the thing. If this is business model or if this is satisfied, then you will go for FVT-OCI method. I'll tell you the accounting treatment also this in a bit, but this is the background behind FVT-OCI method. What about FVTPL method? FVTPL means fair value through P&L account. FVTPL method is a residual category. Okay, it's like God. Yeah. If this also cannot be followed, if this also cannot be followed, if both the methods are not followed, then you go for residual method, which is FVTPL method. Okay, like that. All right. So this is about this accounting treatment. We'll tell you in a bit. So again, what is it? Financial asset. Either you can go for ACM, FVT-OCI, or FVTPL. When you can go for ACM method, when two tests, business model and CCF should be satisfied. What should be the business model? The business model is to hold it till maturity, and the contractual cash flow should only be representing principal and interest. What about the business model of FVT-OCI? The business model is satisfied both by holding as well as by selling. Meaning you may hold it till maturity or you may sell it off also. If that is the intention means, then you will go for FVT-OCI. That is a business model here. And contractual cash flow test is same. And FVTPL method is the residual category. If you can't value a financial asset under ACM method and FVT-OCI, by default you will go for FVTPL method. Like that. Okay, sir. CCF ka some extra pointers I've given. That's fine. Okay. Alright, another thing you need to keep in mind now is the transaction price or transaction cost. Transaction cost. What this means? Sir, let's say you buy equity shares of Infosys by paying 10 lakh rupees. One company, they purchased equity shares of Infosys, okay, by paying 10 lakh. Normally, when you buy a shares, you may have to pay some brokerage also, right? Here, let's say the brokerage is 10,000. Okay, this brokerage of 10,000, we call it as transaction cost. Okay, to to do this part, to buy a particular financial asset or financial liability, if you are incurring any expenditure, that we call it as transaction cost. Okay. So if transaction cost is there, what to do, sir, is what we are trying to say now. Okay. So if transaction cost is there, first check which method are you following. If you are following ACM method and FVT OCI method, then transaction cost will be added to the transaction price. Meaning, so if you're following ACM method, no, then the value of financial asset initially will not be 10 lakh. You pay 10,000 brokerage, no? So financial asset initially will be shown at 10 lakh 10,000 under ACM method. If you're following FVT OCI method, same transaction cost again will be added. So 10 lakh plus 10,000 you will do. So the value of financial asset that you will show in your books initially is 10 lakh 10,000 under FVT OCI. Basically, transaction cost will be added to the cost of financial asset. However, if you're following FVTPL method, how much did you buy the financial asset for? 10 lakh. This transaction cost will not be added. Financial asset will be measured at 10 lakh itself. Whatever is the transaction cost you incurred, no, that will be transferred off to P&L account. So financial asset value will only be 10 lakh. The 10,000 of transaction cost will be straight away transferred off to P&L account. So that is the reason you need to know which method first. Okay. So all these are initial measurement. Okay. All right. So one more thing about initial measurement, if I'll have to know, means, sir, if there is a financial asset, initially financial asset, before you talk about initial measurement, first check whether the transaction is done at market terms or off market terms. Before you go and pass the journal entry for financial asset, you need to check whether transaction is done at market terms or off market terms. So what does this mean? Okay, let's look at an example here. There is one company X Limited. Sir, it's a normal practice of many companies, no? They give some loan to their employees. Yes, they give loan to their employees. Let's say X Limited gave loan to their employees at, let's say, 5%. They're giving loan and they're charging interest on this loan only at 5%. Okay. But the same loan, no, in the market, if the employee takes the same loan from the market, no, sir, the loan ka rate is 11%. In the market, the going rate for that going rate of interest is 11%, but company has issued only for 5%. Now you tell me this particular transaction, X Limited has given a loan to employees, means it's a loan given. On loan given, company has a contractual right to receive cash. That means this loan given is what for the company? This loan given is a financial asset. Yes, fair enough. Now this particular financial asset, initially it has happened at market terms or off market terms. If it has happened at market terms, means interest should have been 11%. Is the interest 11% or only 5%? It is at 5%. That means the transaction here has happened at off market terms. Okay, that's what we mean by market and off market terms. So if transaction has happened at market terms, then whatever is the transaction price, that itself you can record it. Let's say you sold the goods to debtor for 10 lakh rupees. The worth of the goods in the market is 10 lakh. You sold it for 10 lakh. Correct? That means, are you doing it at off market terms or market terms only? Market terms only. That means you will write here, debtors mean, now don't call it as debtors. On debtors, we have a contractual right to receive cash. So instead of debtors here, now we'll call it as financial asset debtors account debit 10 lakh to whatever sales account 10 lakh. Because transaction has happened in market terms, you can pass the entry straight away. Okay. If, however, transaction has not happened in market terms, then what to do is you have to measure the financial asset not at the transaction price, but you have to find out something called fair value. You have to measure this financial asset at fair value. And how do you get this fair value, sir? Fair value is nothing but present value of future cash flows. Whatever is the future cash flows you are getting, no? Obviously, here in this example, company has given a loan, means they will collect periodically interest and principal. So all that they'll collect in future. So this is the future cash flows. So find out the present value of future cash flows by using market rate. By using, in this example, 11% interest rate. Use 11% as discount factor and find out the present value of cash flows. Okay. So let's say you have given loan worth 10 lakh rupees, but present value of future cash flows, let's say, became 8 lakh rupees. That means it is not matching. There is a difference. The difference of 2 lakh, you will treat it as a prepaid expenditure. Based on the transaction, this accounting will differ. Okay. Here you are giving this, you are treating this as a prepaid salary. Okay. So if the loan term is 4 years, means this prepaid expenses will be amortized or it will be transferred to P&L over 4 years, like that. Okay. One more thing you need to keep in mind is this difference. Now, whenever this difference arises, this is rare, but do check this. This is the transaction price. This is a fair value. So obviously there is a difference. If the difference is due to level 1 input or valuation technique, we'll talk about more about this in India's 113 fair value measurement. There is a difference in this here to the extent of 2 lakh, no? So if the problem by chance if they mention the difference is due to level 1 input or valuation technique, then the difference, no, you straight away transfer it to P&L right now. If they use this word valuation technique and level 1 input, otherwise you account it like prepaid expenditure, or in this case it will be prepaid. Case to case basis, it will vary. Okay, we'll take up one question in this regard immediately. Okay, just 1 second. Excuse me. 1 second. Which question is that? Let's look at question number 55, people. Okay, we'll understand our whatever we have discussed so far, we can understand better with the help of this particular question. Okay, A Limited has made a security deposit whose details are described below. Pass the necessary journal entries, assuming the market interest rate is 12%, they're saying. Okay, it's an interest-free deposit. Okay, so you have given some deposit to somebody else. You have given a deposit means you will collect the money back after some time, maybe 3 years, 4 years, whenever. On this deposit, you are not collecting any interest. Now you tell me, sir, will anybody give the deposit without any interest? No. Obviously, in the market, they're saying such deposit carry an interest rate of 12%. In the market, you get 12% interest on deposit, but you in your contract are getting 0%. That means your transaction is happening at market terms or off market terms. Transaction is happening at off market terms. Okay. All right. So you're deposited on 1st April 20x1 and you'll get the deposit back on 31st March 20x6. So this is the lease. So you have entered into a lease transaction and you have given some deposit. The period is 5 years. Discount rate is 12% given already. Security deposit given is 10 lakh. Present value factor at 12% at the end of 5th year. What is the discount factor? They only given. Okay. So now initial accounting. So you have given a deposit. Now think from A Limited perspective. They've given a security deposit. So that means after some point of time, they'll collect this back. So they have a contractual right to receive cash. If they have a contractual right to receive cash, that only we call it as financial asset. Yes. Now this financial asset, how much is the deposit amount? 10 lakh. Initially only can be recorded at 10 lakh? No. Why? This 10 lakh is the transaction price. Did this transaction happen at market terms or off market terms? It happened at off market terms. That means initially, financial asset will be measured at fair value. And how do you get this fair value? Present value of future cash flows. Okay. What is the future cash flows here? There is no interest. You will get your money back 10 lakh at the end of 5th year. And what is 5th year discount factor? 0.567. So multiply this 10 lakh into 0.567. If you multiply, you're going to get 5,67,427. So this is the value of financial asset you will recognize at year 1 ka beginning. But sir, we gave security deposit of 10 lakh. So there is a difference. 10 lakh minus this if you do, you're getting a difference of 4,32,573. Okay. So that don't say prepaid expense. Here it's a case of lease. The difference, have they told anywhere due to level 1 input? No. If they had told level 1 input, I would have transferred to P&L. All right. Is it an employer-employee relationship? If it was employer-employee relationship, we would have treated this as prepaid expenditure. But this has come on account of lease. Okay. You have taken an asset on lease. And already we have studied India's 116. Whenever a lessee has taken an asset on lease, okay, he has to recognize ROU. So this difference will be recorded as ROU asset account. So the journal entry you will pass this on day 1 is, so you have given the money. So to bank, you will credit 10 lakh. Financial asset security deposit, you will debit at present value of future cash flows, which is 5,67,427. The difference, you will recognize it as ROU account debit 432,573. This ROU will be transferred or amortized to P&L over the lease term. How much is the lease term? 5 years. Over 5 years, you will release this into or transfer this to P&L. So this is your year 1 ka accounting. Okay. Then this is your initial measurement. Okay. Subsequent measurement also, let's understand. So first of all, here, sir, what? Yes, you have a contractual right to receive cash. You have given the money now and you will get the money back at the end of 5th year. So contractual, you are getting either interest and principal there. It's not necessary interest and principal should be there. Okay, in some contracts, interest will not be there. Only principal will be there. That is fine. So here you are only getting principal. So now you think about it. Are we going to sell this financial asset? Now I'm testing how should the financial asset be valued. Should we go for ACM method? Should we go for FVT-OCI method or FVTPL method? ACM method, if you want to go, means what should be the business model? To hold it till maturity. Now this particular security deposit, will we sell this to somebody else before 5 years or we will hold it till 5 years? We will hold it till 5 years. At the end of 5th years, we'll get the money back. Yes, no? So the business model is to hold it till maturity. Okay. And then what? Contractual cash flow represents sole payment of principal and interest. That means here in this case, this financial asset will be measured using ACM method. Okay. So which we have already recognized. All right. So subsequently what you'll do, sir, every year end, we have to do something called ACM table we need to put up. All of you, I think, are comfortable with this table, right? So year opening balance, finance income, receipts and closing balance. So initially you have recognized financial asset at what value? 5,67,427. Okay. But this asset, no sir, you have recognized now as 567. But will you get back 567 or will you get back 10 lakh? You will get back 10 lakh. But why have you recognized 567? Because transaction happened at market terms. This is the present value. Present value is 567. Future value is 10 lakh. The difference between the present value and future value is nothing but your finance income or interest income. All right. So if you deposit 5,67,000 money now for 5 years, at the end of 5th year, the deposit will become 10 lakh like that. Okay. So simple. If you take this 5,67,427 and deposit it in one bank for a period of 5 years, and if the bank gives 12% interest rate, then at the end of 5th year, the deposit amount will become 10 lakh. Why? Bank will give you periodic interest. So the difference between these two, that is 432 whatever, no, you have to book it as interest income over here. That is only we call it as finance income. Okay. So it's the same thing. Initially take it as 5,67,427. Interest you book it at effective interest rate. This we call it as EIR or IRR, which you studied in your CA Inter. Here we call it as effective interest rate. So 567 into 12% you do, which will be 68,091. First year, are you getting any receipts? No, you're not. It's because there's an interest-free loan. So you're not giving any interest, receipts over here. First year it's 0. So how do you get the closing balance? Deposit amount is 567. On that, interest is accrued 68. That means how much you will recover? 635. First year ka closing will become second year ka opening. And again on this calculate, so on this 635 calculate interest at the rate of 12%. And you have not received anything. That means at the end of second year, you have to receive these two. The amount will be 7,11,780. Second year ka closing will become third year ka opening. Now on this you calculate 12% interest, which will be 85,000. Again, nothing you have recovered. That means you had to recover 7,11,000. Now you have to recover interest also. So totally you have to recover 797, 194. Third year ka closing, which become fourth year ka. Same drama you do it. At the end of 5th year, you will receive how much? 10 lakh. That means the balance of this financial asset will become 0. Okay. So initially recognize it at 567. Later on at the end of 5th year, you will receive 10 lakh. Okay. That the financial asset will become 10 lakh and you will receive 10 lakh and its balance will become 0. So looking at this only, this we call it as unwinding of interest or ACM table also we call it. Yes. So based on this only, we have to pass the journal entry. Okay. Now what is a simple journal entry? You have shown the deposit at 567, but you will recover deposit after 5 years, 10 lakh. That means deposit amount you should go on increasing. Deposit here it's deposit given. So it's an asset. So asset has debit balance. You have to increase that asset. How do you do that? Something which has debit balance, again, if you have to increase it, again, debit. So the journal entry you will pass in the first year is security deposit or financial asset security deposit account debit. How much is the first year interest? 68,091. To what? Have you received this? No. You'll write to interest income account. Okay. Like this, you go on recognizing the interest income for all the years. At the end of 5th year, security deposit balance will become 10 lakh. And finally, at the end of 5th year, when you receive security deposit, the journal entry will be bank to security deposit, 10 lakh, 10 lakh. And this particular financial asset accounting will be closed. This is your subsequent measurement under ACM method. Okay. So initially and subsequent measurement, both we have seen. Hope it's okay. So let's have a quick walkthrough just in case you have forgotten. All these are simple questions. We have done a lot more complex question and many number of questions in class. But I know that some of you would have been watching this marathon or you would have not taken class from me or watching this for the first time. Okay. So to their benefit, quickly we'll revise. So first check whether the transaction has happened at market terms or off market terms. All right. Here you're giving away, you're given deposit but not collecting any interest. But in the market they are collecting interest. So transaction happened at off market terms. So if the transaction is happening at off market terms means you cannot use transaction price. Here transaction price is 10 lakh. You cannot use that. You have to recognize financial asset at fair value. And how do you get that fair value? By what, sir? Find out the future cash flows, discount that future cash flows at market interest rate. Whatever you get, that is the initial value of financial asset. So in this example, that value was 5,67,427. So the difference between these two, we call it as, this is the lease. So difference was accounted as ROE. Okay. So initially now you are showing financial asset at 567, but at the end of 5th year, you will receive 10 lakh. So the difference between this 567 and 10 lakh is nothing but time value of money ka interest income. Okay. The substance over legal form ka accounting all this is. So go on booking interest at market rate here. You're not receiving this, but it's substance over legal form ka accounting. Like this, go on booking the interest. Okay. So at the end of 5th year, the financial asset balance, or to book the interest, the journal entry will be financial asset account debit to interest income. All right. Go on booking the interest for 5 years. At the end of 5th year, this financial asset ka balance will become 10 lakh. Later, you will receive 10 lakh and this balance will get closed. So this is one question. Okay. I think we have one more similar question. So let's also kind of revise that. 1 minute. Let me try to find what is that. I noted it down. I think 1 second. I've noted down the order. 55 we have done. Next is 96. There is 96 now. Here. Okay. Let's look at this particular question again. As part of staff welfare measure Y Limited, one company, has contracted to lend its employees a sum of money at 5% interest. One company is giving loan to their employees. Actual interest rate of loan is 5%. Okay. The amount lent are to be repaid in 5 equal installments along for principal along with interest. So you're not collecting the principal in one go. Okay. Every year, whatever amount is given in 5 equal installments you need to pay. So every year interest also has to be paid. Some portion of principal also has to be repaid. That's the arrangement. Market interest rate, however, is 10%. In market mein loan ka interest is 10%, but this company gave the interest at 5%. First indication. Transaction happened at market terms or off market terms. Obviously, it has happened at off market terms. So, means how much loan you give. Check here. If I lend 16 lakh, 16 lakh is your transaction price. Can we record a financial asset? The company has given a loan, means on that loan they have a contractual right to receive cash. So this loan given for the company is a financial asset, right? That financial asset initially, can you measure it at 16 lakh? No. Why? Because transaction has happened at off market terms. Hence what we need to do, find out the present value of future cash flows by discounting at what rate? By discounting it at market rate. Okay, that is one we need to do. Okay, following the principle of recognition and measurement laid down in India's 109, you need to pass a journal entry, blah blah blah. They're saying, okay, discount factor they only given. Great, sir. So first we need to find out the present value of future cash flows. In the last problem it was very easy because interest was not there. The only cash flow was principal, right? But here interest is also received and principal is also repaid. So every year company will receive interest from the employees as well as they'll receive some principal. So that means there are two cash flows. So how much is principal given? 16 lakh is a principal given and they have to repay this in 5 installments. So every year they have to pay 3.2 lakhs. So principal to be repaid every year is 3,20,000. Okay. So what will be first year's interest? Okay, this 3,20,000 will be repaid at the end of first year. So the first year loan outstanding is 16 lakh. So 16 lakh into 5%. This is the actual interest rate. Huh? Actually, how much interest the employee is paying? 16 lakh was the loan amount. 16 lakh into 5% will be 80,000. Okay. Next year, out of the 16 lakh, 3,20,000 principal already repaid. So 16 lakh minus 3,20,000 into 5% if you do, you're going to get 64,000. Like that, 48, 32, 16 they've calculated. So every year, this much principal he has to pay, this much interest he has to pay. Okay, first year, how much is the total payment made by the employee to the company? Now we are doing the accounting from company perspective. So first year, company will receive 4 lakh. Second year, this much. Third year, like this. Adding all this, you're getting this particular value. Okay. All right. So this 4 lakh, we are doing the accounting now. This 4 lakh, 384, 368 and all, company will receive in future. So these are all your future cash flows. Okay. Now, how do you find out if transaction has happened in market terms, then what do you do? How do you record financial asset initially? By finding out the present value of future cash flows. That means you have to find out this present value means you need a discount factor. Which discount factor will you use? The market rate. What is the market rate of interest? 10%. So use 10% as a discount factor. They have already given the discount factor in the question already. So multiply the discount factor. So if you multiply these two, you're going to get the present value. And the summation of present value is 14,06,272. So in the year 1 beginning, the company will pass what journal entry? They've given a loan, right? So they will credit bank. How much loan they gave? 16 lakh. What will they debit? They have a contractual right to receive cash. So we'll write financial asset staff loan account debit. So can we debit financial asset staff loan 16 lakh? No. But at present value of future cash flows, which we just now found out to be what? 14,06,272. That means is the journal entry matching? No. So 14,06,272 minus 16 lakh if you do, you're getting a difference of how much? 1,93,738. Okay. Now this is the difference. Have they used anywhere there? The difference is due to level 1 input or valuation technique? No. If that was the case, means we would have transferred the difference to SPL. Okay. Now this difference what to do? The difference what to do no, depends on the relationship. In the previous case, the relationship was between lessor and lessee. Hence we recognized as ROU. Here is between company and employee. That means this particular 193 will be recorded as prepaid expenditure or prepaid staff cost or whatever. Okay. That you will recognize. This is as a balancing figure. Okay. Starting material, my entry is given over here. They pass 2 entries. Don't worry about this entry. If you add these 2 entries, whatever entry are passed only, you will automatically get. Okay. So that is the initial recognition of financial asset. Subsequently, what you do? Subsequently, the same drama. On this financial asset, obviously, sir, the company has given a loan now, this financial asset. Will company sell this asset? No. So they've given a loan means they will wait for 5 years and collect the money back. So that means the business model is what? To hold it till maturity. And on this contract, company is only receiving interest and only they're receiving principal. That means contractual cash flow test is also passed. That means you will measure this financial asset using what method? ACM method. So you need to put up that same ACM table. Okay, here I think they've shown it where. Okay, here check. Initially, opening balance of financial asset is 14,06,272. That's what they've taken. And then you have to book interest charges. Interest is based on effective interest rate. What is the effective interest rate? Which is nothing but market rate. Here, how much? 10%. So you have to book the interest at 10%. So 14,672 into 10% will give you first year's interest. First year, is the company receiving something? Yes. In the previous example, there was nothing paid. Here, first year, the company will receive 4 lakh. So the receipt is 4 lakh. So this 5 is nothing but these two addition. It's like loan. You have given a loan of 14,672. You have to collect interest of 140. In that, you collected 4 lakh already. So what is loan ka closing balance? So basically this plus this minus this. 14,6,272 plus 1,40,627 minus 4 lakh if you do. You're going to get 11,46,899. Okay. Second. Yeah. So that's how you're going to get the closing balance. So first year ka closing will become second year ka opening. Again, charge interest on this at 10%. The receipt is second year receipt is 384, third year is 368, fourth year is 352, last year is 336. So at the end of fifth year, this financial asset ka balance will become 0. Last year, you may get some round off error. Sometimes the round off could be 400 rupees, 500 rupees also, depending on the amount. If the amount is in crores, you may get some round off of 400, 500 also. But generally, the difference is between 100 to 200 rupees. You may get some round off error over here because we are taking only 3 decimals over here. This is not actually 3 decimals. There are more. We are restricting to 3 decimals. That is the reason you may get some slight last round off error. That's all right. So this is about your ACM method ka initial measurement as well as subsequent measurement. Hope that's clear for everybody. Okay. Any doubt here till here, anybody? Yeah, so this is the initial measurement I've written. Subsequent measurement also I've called out over here. Okay, so this is the subsequent measurement under ACM table. Whatever we just did now, that same thing I've called it out in words there. Okay, so what about FVT OCI method, sir? Sir, if you're following FVT OCI method, okay, then initially you recognize if you're following FVT OCI method, initially you measure it at fair value, and at each reporting period you measure it at fair value. Like, what does it mean? Sir, let's say you are following FVT OCI method. Okay, let's say initially you recognized one financial asset at FVT OCI method at 100 rupees. You booked one financial asset for which you are valuing under FVT OCI. Initially you recognized at 100. At year end, no sir, at each year end, let's say this is the first year end, at each reporting period, it could be quarter ending or year ending depending on whether you're preparing quarterly financial statements or not. Let's say this company is only preparing annual financial statements. So at the reporting period here is the year ending for this company. So at each year end, no, you have to value this financial asset at fair value. At each reporting period, this financial asset should be valued at its fair value. Let's say the fair value of this financial asset at year 1 ending is 150. So you purchased it for 100. At year 1 ending, its fair value has become 150. That means this financial asset you have to show in balance sheet at 150 now. But you bought it only for 100. So when you bought it, probably the journal entry you passed was financial asset account debit 100 to bank account 100. Right? But can you show this financial asset has a balance of 100 now? Can you show this 100 in balance sheet? No, you have to show it at 150. So from 100, you need to increase its balance to 150. That means you have to debit it by how much? Financial asset should be debited by 50. That means you have to credit this something. What is the name of this method? FVT OCI method. That means all this is your fair value gain. From 100, it has become 150 means it's a obviously happy scenario, right? It's a gain scenario. So this is a bookish gain or loss. So all this bookish gain or loss, you will park it in OCI. The fair value gain, you will park it in OCI, other comprehensive income. You know what is OCI, right? Yes, so P&L has 2 sections now. One is the main P&L, another one is the OCI section. Okay, all unrealized gains and all comes in the OCI section. OCI is also basically a reserve. Same thing will come in your other equity also. Okay, so this is your FVT OCI come simple method. Okay, initially book it at a particular transaction price and at each reporting period measure that financial asset at fair value. So you may get some fair value gain or fair value loss. Doesn't matter whether it is a gain or whether it is a loss. You'll transfer it off to OCI itself. Hence the method name FVT OCI method. FVTPL method is also simple. Let's say financial asset you are measuring it under FVTPL method. Initially you purchase financial asset for 100. Its fair value at year end has become 150. That means here there is again a fair value gain. How much? There is a fair value gain of 50 rupees. Now you are following FVTPL method. So what will you do for this gain? Will you transfer it to P&L? No. Will you transfer it to OCI? No. So you will pass the journal entry, financial asset account debit 50 to SPL account. So here fair value gain loss will not go to OCI, but it will go off to SPL account. That's hence the method name FVTPL method. Okay, that's what I've called out over here. Done, sir? Yes, sir. Sir, can you change the method, sir? from ACM to FVT OCI, from FVTPL to SC method, yes, that we call it as a reclassification. Reclassification of financial asset is permissible. That's not that important from examination. Quickly, I'll tell. You can just keep these rules in mind and accordingly do. One simple thumb rule is, if you're, let's say, going from ACM method to FVTPL method, two simple thumb rules is, one, if you're doing reclassification, you also the reclassification should be done at fair value on reclassification date. The day you're reclassifying, on that day you need to find out the fair value, and the new instrument will be measured at fair value on the reclassification date. And whatever is the gain loss that you're going to get, to which category you are jumping to, accordingly book the gain or loss. Like here, you're following from ACM method, you want to shift to FVTPL method. So first find out what is the fair value on the reclassification date. Let's say you're changing this classification on 1st January 2025. So on 1st January 2025, find out the fair value. Okay. Let's say fair value was 150. That means under FVTPL method, you're moving to FVTPL method, no? So initially this particular asset will be valued now at 150. Why 150? Because that is the fair value on the reclassification date. Okay. Then what's sir? Sir, let's say initially this particular asset was valued under, the carrying amount of this asset under ACM method was 120. Currently under ACM, this particular asset is shown at 120. But henceforth you have to show it at 150. That means there is a gain of how much? 50 rupees. To which category you are jumping to? FVTPL. That means this gain will be automatically transferred off to SPL account. This is a simple rule you need to keep in mind for your reclassification. Okay. Reclassification will be done at fair value on the reclassification date, and to whichever category you are jumping to, that category the gain or loss will be transferred. Okay. Like here from ACM method, if you're going to FVT OCI method, so you have to use fair value on the, so you need to value, initially you need to value this instrument under FVT OCI, no? So initially it will be valued at fair value on the reclassification date, and whatever gain loss you are getting, now we are moving to FVT OCI method, no? So the gain loss will go up to OCI like this. Okay, so but these three are some exception rules, so just remember this and accordingly put it. May not be that important for examination, hence I'm not going in detail. Okay, so this is about financial asset. So what about financial liabilities? Same thing, sir. For a financial liability, you think financial asset, how many methods? ACM, FVTPL, FVT OCI, right? Now, what is the business model of FVT OCI method? What is the business model of FVT OCI method? Business model is satisfied either by holding or by selling. Now you think about it. Financial liabilities. Financial liabilities means your creditors, loan taken, etc., etc. Creditors, loan taken, bills payable, all this we will sell. Sir, assets we will sell. Liabilities do we sell? No. Hence, FVT OCI method is not permitted for financial liability because we don't sell it. So that business model will not be satisfied. For financial liabilities, only ACM method or FVTPL method is used. For majority of financial liability, you have a contractual obligation to pay cash and at periodic intervals. That is the reason we follow ACM method only. Okay, but for few we will go for FVTPL method. This is basically derivative. We'll talk about this later. Derivative financial liabilities are accounted using FVTPL method. Otherwise, most of the financial liabilities you go for ACM method itself. So can you change from ACM to FVTPL method? No. Here the reclassification from ACM to FVTPL is not allowed. Only financial assets ka reclassification is permitted. Financial liability ka reclassification are not permissible. So that means how do you value financial liability under ACM method, sir? Same steps, sir. Whatever we did for financial asset, same thing you have to do for financial liabilities also. But on financial asset, no. You booked interest income. On financial liabilities, you have to book interest charges. So instead of finance income, you have to book finance charges. That's the only difference between financial asset and financial liability. In terms of accounting, it is ditto, ditto, ditto. Maybe for your satisfaction, I think we can take up one question. I think we have illustration 31. Where is that? Let's try to find out. Excuse me. One second. Yeah, here. So I think this is financial liability wala accounting. So we'll run through this particular question. Okay. A Limited has made a borrowing from RBC Bank. So you have taken a loan. You are not given a loan. You are taken a loan. If you have taken a loan means obviously you have a contractual obligation to pay cash. If you have a contractual obligation to pay cash or any other asset, that means it is not financial asset, it's a financial liability. How much have you taken the loan for? 10,000. How much interest rate? 10%. Loan processing fees was 500 rupees. Okay, there's nothing but your transaction cost. Okay. So, sir, what should we do for transaction cost, sir? Transaction cost you added, sir. No. If it is financial asset, transaction cost is added. If it is financial liability, transaction cost is deducted. Sir, why, sir? Think logically, sir. You have taken a loan. That means how much money you got. You have taken a loan means bank gave you 10,000 rupees. So 10,000 is the inflow for you. All right. But bank collected how much money from you as processing charges? You gave to the bank 500 rupees. That means net mein how much money came to you? You got 10,000 from bank. You gave 500 rupees as transaction cost. That means the net money you got is only 9,500. Okay. So in case of financial liability, that's the reason we say transaction cost should be deducted. It's not a formula. It's pretty logical. Yes, no? Because money is not coming in here. Money is going out. Okay, that's the reason. All right. Okay, great. Next, loan is payable after 5 years in bullet repayment in principle. Okay, so you are paying principal in one go at the end of 5th year. Interest maybe you have to pay every year. Loan amount 10,000. Starting date is this. Ending date is that. Interest rate is 10%. Interest is to be charged and paid yearly. Principal only at the end. Interest every year you need to pay. Upfront fees, that is processing fees, is 500 rupees. How should the loan be accounted? Okay, simple, sir. Is there any transaction cost? Yes, there is a transaction cost. First, one second, go back. Sir, transaction happened at market terms or off market terms? The bank is charging 10% interest rate. Have they told bank charges another rate for another customer? No, obviously bank will not do this based on. Okay, obviously based on your risk appetite, based on your credit worthiness, they will determine the rate. Yes. So obviously you have taken a loan from bank means bank would have charged to market interest rate only. Bank is not your cousin or anybody to give you a lower rate. That means your transaction has happened in market rate itself. Okay. That means what? Initially, you don't have to find out any fair value. Transaction price itself, you can record it at, or financial liability is initially recorded at transaction price. What is transaction price? Don't say 10,000. There is a processing fees or transaction cost of 500. That means initially your financial liability will be valued at 9,500. Okay, people. All right. This is your initial measurement. Okay. Subsequently, what you do? You need to put up that ACM table. But one thing you need to keep in mind is interest, that you book in the ACM table is not actual interest rate. It is based on effective interest rate. EIR. It's nothing but your IRR. You already studied. What does IRR mean, sir? IRR is basically a rate at which present value of cash inflows will be equal to present value of cash outflows. Present value of cash inflow will be equal to present value of cash outflows. So here that is only 10%. No, sir. No. Sir, if this transaction cost was not there, then market interest rate in EIR would have been same. Whenever there is a transaction cost, so the effective interest rate will not be 10%. If you put up the table, if you want as an exercise, take this question and calculate it at 10%. You will not, the final balance will not become zero. There is a difference. It's not round off difference. Okay. There will be an actual difference. Why is IRR is not a 10% here. It is something else. Why? The culprit is transaction cost. Whenever there is a transaction cost, the market interest rate in EIR will not be same. You have to recompute. In many problem, they'll only give. Some problem you need to recompute. How to recompute? They've given it over here. IRR you already studied in FM, sir. How to calculate? You have to assume 2 interest rate. First, maybe we'll start with 10 only. Okay. Find out. You can use our interpolation formula if you remember, right? You remember IRR ka formula? Yeah, that is nothing but your lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. You can use this if you remember this, or if you have forgotten this formula, I'll show you another logical method. If you want, you can follow that. Okay. What is it? Simple. IRR is a rate. It's simple, sir. Now you have received how much from bank? 9,500. Periodically, this is your present value of cash inflow. Okay. 9,500. It should be equal to present value of cash outflow. What and all you have to pay to the bank? Every year you have to give interest. Every year you have to pay principal. Okay. So the present value of these two should be equal. At what rate they are equal is what we are trying to test. So do you know the present value of cash flows? Yeah. So first year, what will be the interest you need to pay? You took a loan of 10,000. Don't say 9,500. 500 rupees is processing charges. Bank will charge the interest. Bank gave you a principal loan of 10,000. So they will charge the interest on 10,000 only. So first year you have to pay interest to the bank 1,000. Second year also 1. Third year also 1. Fourth year also 1. Fifth year you have to repay principal also of 10,000. Interest also you have to pay 1. Principal of 10 you need to repay. Interest of 1 you need to repay. So at the end of fifth year you need to pay 11,000. Okay. So this is your future cash flows. Assume one discount rate. Maybe let's take 10% only. Okay. To prove that 10% is not IRR because 10% is what they've given in the question. All right. Discounted at 10%. Take discount factor 10%. When you add up all the present value, how much are you getting? You're getting 10,000. You're getting 10,000. But the answer you're looking at is what? This is present value of future cash inflows. Okay. Yeah, this is the present value of future cash outflow for us. But what is the present value of cash inflow? It is not 10,000. It should be 9,500. So when you found out the present value, did you get 9,500 or you got 10,000? You got 10,000. That means what? this 10% is not IRR. So you'll have to assume another rate. Okay, it could be any rate. Just maybe take it as here they've taken 13%. You can assume 12, 14, 15, whatever. Let's now test it at 13%. Same cash flow, you use 13% as a discount factor and find out the present value. You are getting 8945. 13% is also not IRR. Why? Sir, if 13% was IRR, means this number exactly would have been 9,500 or closer to 9,500. Is it anywhere closer? No. That means IRR is between 10% and 13%. Somewhere in between that EIR, effective interest rate, or IRR is there. Okay, here we don't use IRR, we use the term EIR, effective interest rate. So it's between 10 and 13. How to find out? Simple. Either you use interpolation formula. If you want to use interpolation formula, you have to calculate NPV. For NPV, you have to consider outflows also, right? 9,500 also you need to consider. And whenever, or if you're using interpolation formula, one more keep in mind, sir, IRR is always from financier perspective. Who gave you the loan? So you have to calculate this IRR. Do remember this. Signs are important. Plus to minus and all, whatever you put, that signs are important. You always calculate IRR from financier perspective because financier determines the rate. Okay. So here bank gave the loan. No? From bank perspective, you need to think what is inflow and outflow and do it. From bank's perspective, the 9,500 is the outflow because they gave this money. And this 1,000 every year that they are recovering, no, it's the inflow. And this 10,000 they'll recover at the end of 5th year is an inflow. So all this you have to show it as positive number. 9,500 you have to show it as negative number. And then calculate. That also you can do. Interpolation ka formula you can use if you remember. If you don't remember, you can always check like this. Okay. So IRR is between these two rates. Check. From 10% you went to 13%. So what is the change in interest rate? From 10 you went to 13%. That means the change in interest rate is 3%. You increase the interest rate by 3%. Correct? Right? What happened to your cash flow, sir? From 10,000, present value of cash flow. From 10,000 it became 8,945. From 10,000 it became 8,945. That means how much is the decrease? 10,000 minus 8,945 is 1,045. For a 3% increase in interest rate, from 10% you went to 13%. So you increase your discount factor or interest rate by 3% and your cash flow from 10 it became 8,9. So it reduced by 1,055. By what percent I should increase my interest rate so that it becomes from 10,000? What is the final answer I'm looking for? I'm looking for 9,500. Why? 9,500 is the present value of cash inflow, correct? No. So by what percentage should I increase my interest rate so that from 10,000 it becomes 9,500, meaning the cash flow should reduce by 500. From 10,000 it becomes 9,500. So cross multiply, how much is this? So 3% into 500 divided by 1,055. 500 into 3 divided by 1,045 if you do, you're going to get 1.42%. So basically I have to increase. This is not 3%. This is 3% increase. Okay, keep that in mind. From 10 I went to 13%. So this is the increase percentage. So I increased my interest rate by 3%. So X here stands for the increase in interest rate percentage. From 10, I need to increase my interest rate by 1.24%. That means my EIR or IRR is 11.42%. So that's how you get EIR. Okay. So the interest that you book in your ACM table is always on EIR basis. Okay. Generally, EIR and market rate interest will be same. However, if there is a transaction cost, interest rate, market interest rate and EIR will not be same. You may have to compute. Okay. It's a simple computation you have done in your FM. You can use your interpolation formula or you can use a logical formula like this. Okay. Whichever way you are comfortable, you can take it. But do remember and do it. Okay. So IRR is 11.42%. So whenever you put up this ACM table, interest you will charge it at 11.42%. And here it will be, so what's this is not receipt. In the previous financial asset, you wrote it as receipt. Now it's a financial liability, so it will be payment. So first year, how much payment was made? 1,000. So how do you get closing balance? So basically, if you want, you can number this. That's what we used to do in class, right? This is 1, this is 2, this is 3, this is 4, and this is 5. 5 is basically 2 plus 3 minus 4. You have to repay 9,500. This is like a loan amount now. 9,500 is loan amount. On that, you have to pay interest of 1,085. So 9,500 plus 1,085. So you have to pay 10,585. In that 1,000, you already repaid. So that means minus 1,000 you do. So loan balance has become 9,585. So first year closing will become second year opening. Again charge interest, again consider payment and you will get the closing balance. Like this at the end of 5th year if you do. Last year you may get some 20-30 rupees round off error you may get because this is a very small number. So hardly 5 to 10 rupees round off you may get and financial liability ka balance will become 0. Okay sir. So this is the accounting. Entry is also same. So the entry will be, you have taken a loan. No? So excuse me, the journal entry will be bank account debit to financial liability. So you will pass the journal entry if you want, simply bank account debit. Though you got 10,500 rupees, you paid as processing charges. So that means bank account debit to financial liability loan 9,500. Okay, this is at year 1 ka beginning. Okay, this is at year 1 ka beginning, and at each year end you have to pass what, sir? This is a loan. No? Loan, you have to charge interest. Interest you already know. Interest is not actual interest here. It is based on effective interest rate. Okay. So right now you have accounted. So what is the journal entry for interest? Interest is an expense, right? So you can write finance charges or interest charges account debit. What is first year interest as per your ACM table? 1085. To what? To financial liability loan. Okay. Then every year you are repaying some portion. When you repay, obviously the loan balance will be same or it will reduce. It will reduce. So when you repay some principal or interest in the first year, so you'll pass the journal entry financial liability account debit to bank account. First year, how much was your payment? 1000. So you'll write 1000 rupees. This entry you go on passing, and this interest charges is an expense which will be transferred off to SPL. So this is your first year entry I've given. Like the same entry you need to pass it for 5 years. So at the end of 5th year, this financial liability loan balance will become 0. So that's your accounting. Okay. Yes. So this also we have covered. Next is 91. It seems. 1 minute. I'll see if it's a concept oriented or a 91. Oh, okay. This is another concept. 1 moment. I'll tell the concept and then we will take up this question. So right now, what and all we have covered. So initial measurement of financial asset and financial liability we have covered. All that is over. Okay, the next important aspect is, this is quite important from examination perspective. Almost every attempt you get one question from this concept. Let's see in the R attempt it comes or not this time. Okay, the concept name is compound financial instrument, or CFI we will call it. So what does compound financial instrument mean? Sir, compound financial instrument means they are those instruments which has features of both financial liability as well as equity. These instruments now have a features of both financial liability and equity. Both we have. Okay. All right. So in this case, what to do, sir? Sir, give me an example, sir. Sir, you have a convertible debentures. You have a convertible debentures. So now check. Financial liability. Equity means you should not have any obligation to pay cash. Financial liability means the company should have obligation to pay. Now, when you're talking about convertible debentures, on this convertible debentures, every year company has to pay interest, right? Let's say these are 10% convertible debentures. That means every year company has an obligation to pay interest at the rate of 10%. So there is an obligation. So the interest portion constitutes financial liability. But principal is the company, let's say the converted debentures is worth 10 lakh. So let's say the term is 5 years. After 5 years, does the company have obligation to repay this 10 lakh? No. This 10 lakh will be converted into equity shares, right? So that means the principal portion will be converted into equity shares, means there is no obligation to repay. So this represents your equity portion. So this particular instrument has both equity as well as financial liability. Hence, such an instrument we call it as compound financial instrument. So if this is the case, means how to do the accounting. You have to show equity also, you have to do financial liability also. So how to find out, sir? Yes. Financial liability is accounted at present value of future cash flows. Okay, discounted at market rate, right, initially, because usually market rate and AR will be same, but you use market rate. Sometimes it could be different also. So you find out the financial liability by discounting present value of future cash flows at market rate. Let's say you get this to be 10 lakhs, okay, or let's say you get this to be 7 lakh. The total compound financial instrument ka transaction price, let's say, was 9 lakh rupees. CFI ka transaction price is 9 lakh. Okay, but present value of future cash flows, if you do, you're getting 7 lakh. So this, out of this 9 lakh, no sir, out of this 9 lakh, 7 lakh you will account it as financial liability and 2 lakh you will account it as equity. Okay, that's how you split. They will give you one transaction price. This split up we need to find out. So how do you find out financial liability portion again? By discounting present value of future cash flows at market rate. Okay, and the difference between transaction price or total proceeds and financial liability portion becomes your equity portion. Thereafter, financial liability, you do ACM accounting. That usual ACM table, you put it up. For equity, there is no remeasurement concept, because equity, there is no obligation to pay cash. So you keep it like that only. So at the end of 5th year, at the end of the instrument, what to do? That maybe we'll learn it with the help of one question itself. We said question 91. No? So let's go over question 91. Sir. Okay. So let's look at this particular example. A Limited has issued 1 crore convertible bonds on 1st July 20x1. Okay, INR. So this is worth of the bond is 1 crore. The bonds have a useful life of 8 years. The face value of each bond is about 10 rupees each. They offer interest payable at the end of each year at 6%. On this bond, you are paying an actual interest rate of 6%. The bonds are issued at their face value and each bond can be converted into one ordinary shares in A Limited at any time in the next 8 years. Okay, so this bond, no, bond ka interest you will pay every year, but at the end, the principal you will not repay, rather you will convert it into what? One ordinary shares. One bond, on one bond you will give one ordinary shares like this. How many bonds we have? We have 1 crore, total worth of the bond is 1 crore divided by 10 if you do, we have 10 lakh bonds. That means you will issue 10 lakh equity shares, right? Okay. Companies at a similar risk profile have recently issued debt with similar terms without the option of conversion at 8% interest rate. Okay. Sir, you have put some conversion biscuit, conversion goal you have given. Sir, actually on this bond, you have to give 8% interest rate. Why? Because everybody in the market are offering 8%. Now, if you offer 6% interest rate, nobody will buy. So you brought in you use some extra tactics. You told the investors, on this bond, I will only give 6% interest rate, but I will also convert your debentures into equity shares. Because you gave this, because sometimes, let's say you are a growing company, that means equity shares will be highly valuable. So the investors are okay to accept lesser interest rate. The market may expectation is 8, but these investors are ready to settle for 6. Why? Because you have given this conversion biscuit extra. Because of that, they are ready to accept lower interest rate. Okay. So if this was not there, means the market interest rate would have been 8%. Okay. So hence, obviously, this is what sort of an instrument? It has equity feature as well as financial liability. So this is basically a compound financial instrument. So proper accounting entries and all they're asking. Okay. So let's quickly run through this particular question. Okay. First, so how much loan you give, sir? The bond value is 1 crore rupees. Okay. So that's what they've called out over here, 1 crore. So you have issued bonds, so you have received money. So bank account debit 1 crore. But this particular instrument has financial liability also, equity also. That means first we need to find out financial liability value. So working out number 1 is to find out financial liability value. And how do you find out financial liability value? Present value of future cash flows. Discounted at what rate? Market rate. And how much is the market rate here? 8%. So discount the future cash flows at 8% interest rate. Okay. Now first, sir, whenever you're considering future cash flows, future cash flows here is what? Interest and principal. The question is interest you are paying. So interest you will consider. What about principal? Should we consider or not consider? That depends, sir. So always in the question, check whether it is compulsory convertible or optionally convertible. Have they anyway used the term compulsorily convertible? No, right? So that means it's an optionally convertible, and generally we assume that the holder, not the company, holder has the option. Generally we assume that. So if it is optionally convertible, means whenever you calculate present value of future cash flows, consider interest also, consider principal also. Okay. Only if it is compulsorily convertible, means principal you will not repay. You will instead of repaying principal in cash, you will give equity shares. If it is optionally convertible, anything could happen. We don't know. If it's in fact, the moment you don't see any word of compulsorily convertible over here, always consider interest and principal for your present value of future cash flows. Okay. So 1 crore is a bond value. Interest rate is 6%. That means every year you have to pay how much interest? You have to pay 6 lakh interest. Okay. And the interest payment is for what is the term of this bond? 8 years. Every year interest is same. So if every year interest is same, means we have to calculate individual years ka discount factor. No, we can use PVAF. Correct. Now all this we are comfortable, I believe. Yes. If every year ka cash flow is same, so you don't have to do the calculation 8 times. Simply you can add the discount factor. Not only that, added discount factor. All the 8 years ka discount factor put together you can consider. That only we call it as PVAF. So 1 divided by what is the interest rate here? 1.08. So 1 divided by 1.08 press equals to button 8 times. 1, 2, 3, 4, 5, 6, 7, 8. And then press GT button, grand total button. You're going to get PVAF, which is 5.7466. 1 divided by 1.08 press equals to button in your calculator 8 times. And then there will be a GT button. You can do that. Or there is equals to an M plus button also you can use. There is another way also. Whatever you're comfortable, you can do it. But take it. Yes. So PVAF is this much. So multiply. You're going to get present value of interest to be this nothing but your present value of interest. 34,47,960. So similarly, they did not use the word compulsorily convertible. So that means principal should be considered. Yes. Principal of 1 crore also should be considered. Principal you will repay every year. No, it will only be repaid at the end. And here end means 8th year. So you have to consider 8th year ka discount factor. PVIF you have to consider for year 8. So 1 divided by 1.08 equals to button 8 times you press. 1, 2, 3, 4, 5, 6, 7, 8. My calculation is showing 0.5402. That's what they've taken, 5403. So if you multiply, you're going to get 54,03,000. So adding these two, this is nothing but your present value of principal. Adding these two, you're going to get 88,50,960. Okay. So this 88 lakh is nothing but your financial liability value. But the transaction price is how much? 1 crore. So in 1 crore, if 88.5 lakh, if it is financial liability, means the balance will be equity. The balance will be 1 crore minus 88 lakh 5960, which will be 11 lakh 49,040. That is balancing figure is equity. Okay. So initially, when you pass the journal entry will be you have issued bond. So the company will receive money. So cash or bank account debit 1 crore to financial liability convertible bonds, which is how much? 88 lakh 5960 to equity component of convertible bonds, which is 11 lakh 49,040, like this. And on this financial liability, you go on doing your normal accounting. You have to put up the ACM table. That's what they put up here. Okay. Okay. So again, what is it again over here? When you put up the ACM table. So again, I mean, I think I don't have to go for that again, right? It's pretty much simple, right? So consider that and put up the ACM table and go on booking the interest expense. That's what they put up here. They combine. There is one interest for interest accrued. For interest accrued, what is the journal entry? This is financial liability. So there will not be interest income. There will be interest charges. So it will be interest charges account debit to financial liability. And when you repay some money, the journal entry will be financial liability to bank, right? Those two entries, they club and pass compound entries like this. You pass it like the regular way. You don't have to worry about this. Effect is ultimately the same. Okay, sir. All right. So like this entry you will go on passing. At the end of 8th year, what will happen? So check what have they told in the question, because anything could happen. No? Check what have they told here. Provide accounting entries if the holders of the bond. So holder probably had the option. Elect to convert the bond into ordinary shares at the end of 3rd year. Oh, okay. Because it could have got converted anytime in 8 years. No? Okay. 3rd year itself, holder said, give me equity shares. Okay. So that means what, sir? At the end of 3rd year, no, you have to put up ACM table for 3 years. No need to put it for 8 years, because anyway, conversion is happening at the end of 3rd year itself. So at the end of 3rd year, when you put up, you remember, no, ACM table, what is the normal one? Year, opening balance, finance charges, and then it will be payment. The last will be closing balance. This is column number 1, this is column number 2, this is column number 3. Okay, this is column number 4 and this is column number 5. How do you get column number 5? 2 plus 3 minus 4. Okay, so 3rd year closing balance, if you take it, is 92 lakh 1,821. Okay, that is the value of liability. Now this liability, is it there anymore or it's converted? Since the instrument is converted, you don't have the liability on. So liability account needs to be closed. So financial liability account 92 lakh 01,821. This you got it from your ACM table 3rd year, because settlement is happening on 3rd year. You will debit that. So initially, when you receive this compound financial instrument, you also created one equity. Yeah, right? So this is basically your other equity. This is okay. If you check your format of financial statement or in your other equity, you will see. Okay, equity portion of compound financial instrument, there is a separate column. So this and all will be shown there. So it's basically reserve and surplus. Okay, not only. Okay, so 11,49,040. This also you need to close. This has credit balance, so debit it. What happened? Did you settle this by cash? If you have settled this by cash, you would have written to cash. You have not settled this by cash, but by giving equity shares. That means you will write here to ordinary share capital, which is nothing but your equity share capital. How much is your equity share capital? You issued 10 lakh equity shares. I think they said 1:1 ratio. No? What did they say in the problem? Yeah, 1 crore. So obviously, like if your bond value is 1 crore, means equity shares also will be issued for 1 crore. So equity share capital you will credit to the extent of 1 crore. Balance will be your, you'll think that these shares are issued at premium and transfer it off to security premium account. This is your balancing figure, like this. Okay, so this is the journal entry for when the holders exercised the conversion option. So what if a holder exercised redemption option? Because he could have either gone for equity shares or he could have left it, right? Because normally the choice will be there with the holder. Either he can, after some point of time, he can accept equity shares and settle it, or he may want the cash back only. If he wants cash, means the journal entry will be first. Same. Let's say at the end of 3rd year, company paid cash and settled. Assumption. So then the entry you will pass is financial liability account debit. Same. Financial liability, you will write what? This convertible bonds or whatever account that you are using, which is 92 lakh 01,821. Okay. Fine. To bank account. How much ever you have settled. Let's say you have settled the same amount. Let's assume. Okay. This will be this. So this way, this liability account will be closed. Okay. But when you initially accounted it, there was one equity portion also. Right? Is that instrument there now? It's fully closed. Fully closed. That means this also needs to be closed. So you have to pass one more journal entry. What are you calling that as? Equity component of convertible bonds. It has a credit balance. How much? 11,49,040. This will be released it into retained earnings. Okay, you will release this off into the retained earnings. From other equity, it will move up to the retained earnings. That's what it's saying. Okay, you will pass this entry when he has settled in, when the holder has opted for cash option, meaning you have redeemed by cash. So by chance they ask that, this is what you do. That's what I've written in the chart book over here. Let me show you. Yeah, if it is redeemed, then you will write financial liability portion account debit to bank account. Okay, and the equity portion will not go to free reserve. By free reserve, I mean it goes up to retained earnings. That's the one. If he goes for conversion option, then the journal entry will be same. The 8% debentures account debit and the equity portion account debit to equity. This you can pass separate entry or you can club this. I think do the clubbing entry, it will be easy. Financial liability portion, equity portion account debit to equity share capital to security premium account. So this is your compound financial instrument accounting. Easy only, but you need to be a little careful when you're doing the accounting here. These are quite important from examination perspective. I think we have one more question on compound financial instrument, 95. Maybe let's run through that. 95. Where is 95? Over here. This one. Excuse me. ABC, it's a company. They've issued 10,000 compulsorily convertible cumulative preference shares. Underline the word compulsorily convertible. So the moment you read compulsorily convertible, what does it mean? Obviously, sir, these instruments will have what, sir? See, preference shares means you have to pay dividend. Periodically, you have to repay dividend. So that means there is a financial liability aspect. But principally, you don't have to repay because it may be converted into equity shares. So obviously, it has features of both financial liability as well as equity. So these are all compound financial instrument. In compound financial instrument, you have to account both financial liability as well as equity. And how do you get financial liability? Present value of future cash flows discounted at market rate, right? Okay. Whenever you're considering cash flows, the word compulsorily convertible or not makes a difference. If it is compulsorily convertible, then you'll only consider the interest amount. Here, it's not a case of interest. It's a preference shares. So instead of interest, you'll only consider dividend over here. Principal portion should not be considered to find out the present value of cash flows over here, because these are compulsorily convertible. Principal portion you'll never pay. That is the reason. Okay. All right. The rate of dividend is 10% payable every year. Preference shareholders are convertible into 5,000 equity shares at the end of 5th year. When CCPS are allowed, compulsorily convertible preference shares are issued. The market rate of a similar instrument without conversion option is 15%. So if now you are giving an option of conversion, right? If you are not given the option of conversion, then the interest in the market rate in the market was 15%. Because you have given this conversion option, investors are willing to accept lower dividend rate of 10%. Otherwise, their expectation would have been 15% because 15% is market rate. Transaction cost is 2%. Sir, I already told you. So this is market interest rate, right? Whenever there is a transaction cost, right? If there is no transaction cost, then market rate and effective interest rate are same. However, if there is the transaction cost, then market rate and effective interest rate will not be same. We may have to compute, or they themselves will give check what happened. So date of allotment they've given. So 5 years is the term, right? Okay. Then what have they told? Number of preference shares, value, proceeds they've given. 15 lakh is a preference shares. Actual dividend rate is 10%. Market rate is 15%. Transaction cost is 30,000. Face value of conversion is 10, and you're giving 5,000 equity shares. That means when you convert, total value of equity shares will become 50,000. Effective interest rate, they've only given 15.86%. Good. We don't have to compute. Okay. So all we have to compute is what? So initial measurement, since this is a compound financial instrument, you have to recognize financial liability also, equity also. How do you recognize financial liability portion? By discounting present value of future cash flows. What is the cash flow here? Sir, you have issued 15 lakh worth of preference shares, and on that you have to pay a dividend at the rate of 10%. So 15 lakh into 10%. So every year you have to pay a dividend of 1 lakh 50,000. Okay, no? So they have calculated for each year. They have used PVIF. So you can use PVAF, no? So 1,50,000 into PVAF you do at market interest rate, which will be 15%. Okay, for how many years? 5 years is the term of this instrument. No, we read this for 5 years. So 1 divided by 1.15 equals to 2, 3, 4, 5. 5 times press equals to button and then press GT button. So it will be 3.3521 into 1,50,000. That will give the present value of cash flow to be 5,02,823. I'm getting. That's what they have also got over here. Yes, this is easy. One line may you can calculate. Okay. Either you can calculate each year ka discount factor separately. Okay, like this. That's a time consuming affair. Use PVAF approach. So this is the value of your financial liability. So what about principals? Principal should not be considered because it is compulsorily convertible preference shares. Okay, that way. So this portion represents your financial liability. But what is your transaction price? How much money did you issue or did you raise by issuing preference shares? 15 lakh. So your transaction price is 15 lakh. So in 15 lakh, if 5 lakh 2,000 something is financial liability, means balance will be what? The balance will be 15 lakh minus 5 lakh 2,823, which will be 9 lakh 97,167 is your equity portion. So that's the first step. So initial measurement, this is working out number 1. Okay. All right. Then what? Subsequently, For financial liability, you do ACM accounting. Okay, but actually there's one more over here. 1 second, hang on. So initial portion is this. Actually, yes. If it was a normal problem, yes, you on the financial liability, you would have done ACM accounting, and at the year end, you have to worry whether this preference shares are converted or what happened, etc., etc. You would worry. Yes. But 1 second, hang on. Here there is also transaction cost. Yes, this is a financial liability. So obviously we're following ACM method. So what should we do for transaction cost? Transaction cost is deducted, but hang on, sir, the transaction cost is 30,000 for the whole instrument. This is not one instrument. This is a compound financial instrument, right? This is a CFI, and CFI has financial liability also. It has equity also, right? That means the transaction cost of 30,000 you have incurred. No, it is for the whole instrument. That means it does not relate only to financial liability. This transaction cost of 30,000 also relates to financial liability and equity. So this transaction cost also has to be split among financial liability and equity. So how's it equally? No. What is the value of financial liability? Initially you've got it 5,02,823. What is the value of equity you got? 997,177. Add these two. How much are you getting? 15 lakh. So in this particular ratio, in this 5,02,823 is to 997,177. In this ratio, 30,000 should be apportioned. 30,000 in this particular ratio, you need to apportion. Okay. So for liability portion, you're going to get 10,056. For equity portion, you're going to get this much. And we know, since it's a financial liability, this is your transaction cost. Transaction cost should be added for financial liability or deducted. Transaction cost should be deducted. So 5,02,000 minus 10,000 you do, you're going to get 492. 997 minus 19 you do, you're going to get 977. That's how you're going to get 14,70,000. Is that okay? Fine. So this one step, do not forget it. Okay. So your transaction cost, since the instrument has two components, transaction cost also has to be allocated in this ratio only. Initially, whatever you got financial liability and equity, in that particular ratio, transaction cost has to be allocated. Now you're going to get the revised. This is your correct value of financial liability and correct value of equity. Henceforth, it is the same. For this financial liability, do the ACM accounting. This is what they have put up the ACM table. 492, 767. That's what we got it here. No, that's what they've taken it. And interest, you will book it at what? Don't say market rate. Okay. Interest will always be booked at effective interest rate of 15.86%. Here already given. So you'll book. Don't worry about this table and all. They'll present each problem in one way. You stick to the normal table. You start with 4,92,767. On that 15.86% if you multiply, you're going to get 78,000. Next column is your payment. Every year you have to repay dividend. No? Dividend payment is 150 for 5 years. Go on repay. So that means at the end of 5th year, the balance will become 0. So financial liability portion has completely become 0. What about equity portion? Initially you recognized equity at what value? Don't say 997. After allocating transaction cost, it has become 977, 233. So last entry, this is the usual entries, no change. Financial liability, you have to book interest, payments and all. No? That entry they have given. Last entry I shall discuss with you. Every year they have given. Equity portion still has a balance of 977, 233. This is your reserve basically. Okay, that's also you need to close. At the end of that instrument, 5th year, 8th year here, what happened? This instrument got converted. As what? You issue 5,000 shares. We wrote initially also here, no? You have issued 5,000 shares and each face value is 10. That means equity share capital will be credited to the extent of 50,000. So this basically equity portion will be debited because that instrument is closed now. To equity share capital 50,000. Balancing figure, you will transfer it off to security premium or whatever is the balancing figure. Okay. All right. So this is your end-to-end accounting of both optionally convertible compound financial instrument as well as compulsorily convertible compound financial instrument. So keep aware of that. First working note is very important. If at all you're doing a mistake, it will be probably in that first working note. Financial liability ka value finding it out affair. Okay, that is where majority of you may go wrong. So hence I told just keep a watch out for that because rest everything is the same step being rinse and repeat kind of a step. This is not much of a change. Okay. So problem may look lengthy because if you have to pass 5 years ka journal entry, in fact, I have showed you compound wala entry, right? You can show in that table also. Like here, if you want, in exam, if you don't have time, you can pass the entries like this in columnar format. Year 1, year 2, year 3. Let's say you have to pass the entry for 5 years. You pass the entry in columnar format like this. Because here in these cases, no, sir, entry will not change. Because every year, if you just check, what is the first entry here? The first entry here is bank account debit to financial liability portion to equity portion, whatever is that. Okay, and on this financial liability of the book, periodic interest. So the journal entry will be interest charges or finance charges account debit to financial liability. Will the entry change? No. First year also you need to pass entry, second year also, third year also, fourth year also, fifth year also. Amount will change, but entry will be same. So this way you can pass the entry once and go on updating the amount in all the cases. That is one. And then Every year you have to repay some money. So when you repay some money, the financial liability portion will reduce. So your financial liability account debit to bank. How much ever you repaid. I think here you will repay 1,50,000 every year in the form of dividend. So go on updating that amount in all the columns. Same entry. Okay. And this interest charges will be transferred off to P&L. Okay. Last year, man, like this equity portion will get closed. So the entry will be equity portion account debit to equity share capital to security premium. But be careful which column you are updating. This entry should be updated in the last year column. So here you will pass this particular entry. That's all. So like this, if you pass, it will save you some time. That's what I've shown you in class as well. For even share-based payment, for many of our chapters, we have followed the entries in columnar format. Should be okay in my view in examination. Because saves you a lot of time. And time is very essence, especially in a paper like FR, because generally FR paper are on the lengthier side. Subject is also very voluminous and it also takes a lot of time. I mean, your writing speed has to be extremely good to complete the paper fully, especially in FR. So writing practice is very important for papers like FR and direct tax especially. All right, so this is about compound financial instrument. Let me see if I have any more question. I think this too we have covered. Next is 103, it seems. Let me see what's that 103. I think maybe we can cover off this and then maybe go for the next one. Okay, 103. I think there's one RTP1 question. Okay. Yeah, 103. Yes, in class we have done more than 100, almost 115 questions in this chapter. Okay. But right now I can't revise all 115. I can revise only few. That time almost for this topic only in our regular class, we spent almost 30 hours. Okay. Now I have to revise everything in about 2.5 hours maximum. Yes, not more than that. Yes. All right. I've already crossed 1.5 hours now only. Yeah. All right. We'll see. KK Limited has granted an interest-free loan of 10 lakh rupees to its subsidiary company. So one parent company has given an interest-free loan of 10 lakh to subsidiary company. There is no transaction cost. If there is no transaction cost, then market rate and effective interest rate will be same. The company has not finalized any terms and conditions, including applicable interest rate. The board of directors of the company are evaluating various options, has required your assistance. They're asking. They've given 3 scenarios. What is that? Loan given by the parent, KK Limited, is to wholly owned subsidiary, is interest free, and this loan is repayable on demand. Sir, whenever they say loan is repayable on demand, no, you don't have to do your sophisticated accounting. Sophisticated accounting here means, so loan means obviously there is you don't sell the loan, right? So you follow usually ACM accounting. So ACM accounting, you have to put up that ACM table, blah, 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 and do a whole lot of accounting. But if they use the term, this loan is repayable on demand, you don't have to do all that. Yes, you'll pass a simple journal entry. What is that? What is the loan amount? 10 lakh. So who gave the loan? Parent. So in parent KK books, they have given the loan. So that means they will credit bank to the extent of 10 lakh, right? They will simply debit loan to I Limited account debit to bank. That's all. So no need for sophisticated accounting because this is loan is repayable on demand. Whenever parent asks, subsidiary should give. They gave the loan today. After 1 month, if they ask, the subsidiary cannot say no, they have to receive it. That is the reason whenever a loan is repayable on demand, you don't have to do any sophisticated accounting. Simply do your golden days ka accounting. What is the journal entry you used to pass for loan given? You used to pass the journal entry as what, sir? Loan account debit to bank account? Yes, that only you pass the journal entry. Here is what this. This is a journal entry the parent company will pass. And whenever the loan is repaid, the journal entry will be bank account debit to loan account when it repays. What entry subsidiary company will pass? They've received the loan, so they will pass the journal entry, and this is repayable on demand. So you use your golden days approach. What is the journal entry for loan taken? Bank account debit to loan account. So you'll simply write bank account debit to loan from KK account. And when you repay the loan, loan to KK account debit to bank account. This is a simple journal entry. No need for that ACM, blah, 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 and all is not particularly required. Okay, sir. So this is a simple treatment. First scenario. Second scenario, the said is an interest-free loan and it will be repayable after 3 years. Now it's not repayable on demand. It is repayable after 3 years. That means now you have to apply the actual accounting. What is that? They've given interest-free loan, but in the market, they'll sell interest rate check. The 3 years within which they have to repay the loan, the current market rate of the loan is 10%. In the market, this loan carries an interest rate of 10%, but parent has given this loan at free of cost. That means this transaction has happened at off-market terms. If transaction has happened at off-market terms, can we record it at transaction price? No. We have to find out fair value. Initially, you should recognize that particular financial liability or financial asset at this particular fair value. And how do you get fair value? Present value of future cash flows at market rate. Okay, so you have to use the discount factor. In fact, that they only given. The fair value of the loan and the recognition is 8,10,000. They only computed. Such nice problem. Okay, the fair value is 8,10,000. That means what is the journal entry you'll pass in the second case? This is the second case. So you have to take the call based on marks. If it's only 3 marks, don't worry about theory. Okay, only if they ask you to analyze, do the analysis parts and give you some pointers. Otherwise, straight away you have the accounting treatment, it is fine. Okay. So for KK Limited, they gave the loan. So they will write to bank account 10 lakh. So for loan given means they have a contractual right to receive cash. That means for parent, it's a financial asset. So you will write financial asset account debit, right? They'll use the word loan. So you can simply call it as financial asset hyphen loan to KK Limited or loan to IK Limited account debit. How much loan will be recorded at fair value? What is the fair value they have given? 8,10,150. 8 lakh 10 you have debited, 10 lakh you have credited. There is a difference, right? That difference. Have they told this difference is due to level 1 input or evaluation technique? No. In that case, you would have transferred to SPL. So if it is not due to those level 1 input, then you have to analyze the relationship. What is the relationship here? Employer-employee? No. Lessor-lessee? No. Parent and subsidiary. So this difference of 1 lakh 89, parent will treat it as an investment made in subsidiary company because it is their own company. So they feel that they would have invested in subsidiary company. So this is arrived as a balancing figure. So if it is parent and subsidiary, then the balancing figure will be treated as investment made by the parent in a subsidiary company. So you simply write it as investment in subsidiary account as balancing figure. Okay, sir. And on this loan account, you go on doing your ACM accounting. That's what they told over here. So you have to book interest charges. Okay, whenever you receive the money, and you are not receiving any money here because it's interest free. Okay, at the end of third year only you will receive money. This interest here, it's a financial asset. On financial asset, you will not book interest charges. You will book interest income. That's what they told. And this interest income should be transferred off to P&L. And when you receive the loan, ultimately bank to loan 10 lakh, 10 lakh. So put up the ACM table and do the accounting. This is your normal accounting. Fine, now people. What about this investment? So as long as you have subsidiary relationship, this investment account will have a balance. Okay. Till then, it will not get closed. So its balance will be as it is. So this is the journal entry in the books of parent. Next, they've also asked the journal entry in the books of subsidiary company. In subsidiary books, what do you need to do? They have taken a loan. So that means bank account debit 10 lakh. For them now it's a financial liability. Financial liability, since the transaction has happened at off market terms, financial liability will be recorded at fair value. And what is that fair value? 8 lakh 10. The difference they will treat it as capital contribution from or equity contribution from the parent. They'll treat it as equity contribution from the parent. It's basically reserve based. Other equity. They will show this under other equity. Okay. So parent will treat it as an investment made in subsidiary. Subsidiary will treat it as capital contribution or equity contribution from the parent. This is arrived as a balancing figure. And on this financial liability, do your normal ACM accounting, put up that particular table, book the interest charges, transfer that interest charges to P&L, etc. etc. Okay. And the equity contribution account will stay as it is. As long as the holding subsidiary relationship is there, that equity contribution and that investment account balance or the ledger balance will still survive. Okay. So that's about this particular accounting. I think there's one more scenario here. What are they talking about? One more scenario. The said amount is interest free and will be repaid as and when YK Limited, subsidiary company, has funds to pay. So they're saying it is not repayable on demand. Subsidiary is saying I will pay the money whenever I have money. Okay, whenever I get money, I will pay. India says nothing doing. In that case and all, no, what you have to do is what India says is this and all will not accept it. Okay, so it is not repayable on demand. Just because you say we will pay when you have funds, it is not repayable on demand. This scenario, we don't call it as not repayable on demand. Okay, that means you have to do your ACM accounting over here. So you have to estimate what? You have to estimate when the payment will be made. Your YK Limited has to estimate the payment will be made in 3 years, 4 years. Obviously, you prepare cash flow projections. So based on that, you can decide when the payment or when this loan will be repaid. So estimate when the payment will be made. Okay, let's say you make the payment within 5 years. That means keep 5 years as a base and put up your ACM accounting. Meaning, third scenario accounting is same as second years. Second year may that given the term as 3 years. In the third scenario may you have to estimate the term and do your ACM wala accounting. You cannot escape from this. Here we don't know the term, so you have to answer this only theoretically. You can answer this practically. So just simply call out this as 2 points. This is not repayable on demand. You have to estimate the term and do the ACM accounting as we have done in second step. Those 2 points, if you're right, that is good enough. Okay. Yes. So I think this question is also done. Okay, next is 82. I think 82 has a small concept. First, we'll do that concept and then I'll come to that. In the meantime, I'll just check anything else is there. I'm doing the most concepts which are more relevant for exams. Huh? Okay, there are many concepts. So, but in the interest of time, I'm doing the ones which are more relevant for us. Yeah, this one. This is quite, again, one important concept. Compound financial instrument, debt restructuring, derivative. These three are very important from this particular topic. You can expect almost normally at least one question comes from these sort of things. Let's see the certain way what happens here, because there is an MCQ also. No, now it's very difficult to say. Institute options has got little limited now in terms of asking big numerical questions. So after finishing this topic only break, or not before that. Yeah, just in case you're wondering when this guy will give break anta. Okay, we'll have to finish this and then only we'll worry about the sapadu, the foodu, tindi, uta, whatever that you want to do. Yeah. Okay. Debt restructuring. Sir, debt restructuring means, okay, you are modifying some of the old terms. Some old terms have been modified and some new terms have been agreed upon. Like COVID was a perfect example, or if you have done bank audits, you must be aware of this. Corporate debt restructuring, they say, right? Many companies, so they take a loan, okay. After a few years, they may face some difficulty in repaying the loan. So they'll approach the bank and tell, reduce the interest rate, no, or extend the period, no. Like this, they will ask for some modifications or alterations. That alterations only, we're calling it as debt restructuring. So some old terms have been cancelled or modified and some new terms have been agreed upon. So some amendment has happened in financial asset or in financial liability, okay. Fair enough. So that amendment only we're calling it as debt restructuring. So if that amendment happened, what we should do for the accounting is what we are trying to test in this particular case. So first, sir, whenever there is an amendment, whenever there is a change, first check whether the change is substantially different or not. First, you need to identify whether the change is made is substantially different or it is not a substantially different change. So how can we tell? So two things you need to compare. What are those two things? First, so normally, let's say like due to COVID, many companies were not able to repay the loan to the banks. So they asked for the extension period, etc., etc., and they asked for a reduction in interest rate. So that means what? Some new terms would have got introduced in debt restructuring wala plan, correct? So first find out the present value of cash flows. Present value of cash flows under the new terms. Under the new terms, instead of 5 years, the period might have become 8 years, correct? The period would have changed, interest rate would have changed. So first find out the present value of cash flows under the new terms. Okay, fine, but using the old effective interest rate or using the old rate that would be given to you in the question. So you find out the present value of future cash flows using new terms, but by using old discount rate. And if there's any fees paid, generally, normally when you're doing this debt restructuring and all, no, bank has to review your file. They have to again do your analysis, credit worthiness, your risk profiling they have to do. For this, they will incur some cost, which they may recover from the borrower. So if you're paying any such charges to the bank, so that also needs to be considered. That is also your cash flows. At any which way, present value of that, you don't have to worry because the payment you will make it today only. And modification happens today only. So that means this is already there on present value platform. So finding out present value of this is not a necessity. Any fees received if you have rarity, that will be more for the banker, not for you. If it is fees, if you have received means reduce. Fees paid, you add. Fees received, you need to reduce. Because all this we are talking about outflows. That's the reason. So find out this. Basically, present value of future cash outflows, no? You find out using the old rate. But at new terms, but you have to use old discount rate. Compare it with carrying amount of financial liability on the modification date. Whenever you have done this alteration, first find out the carrying amount of financial liability. So how will you get this? You would have anyway prepared ACM table, no? Right? From ACM table, you obviously have ACM table ka last component is what? Closing balance. So the closing balance will give you carrying amount of financial liability on the modification date. So compare this. Let's say this was 100 rupees assumption. This was, let's say, 80 rupees. Okay, that means there is a difference. What is the difference between these two? 20. So you calculate the difference in percentage. Okay, how do you calculate the difference percentage? So the difference amount is 20 divided by original amount. What is the original amount? 80. So 20 divided by 80 you do. 20 divided by 80 if you do, you're going to get 1/4. That is something about 25%. So what the standard says is if the differential percentage between these two, if it is equal to or greater than 10%, if it's greater than or equal to 10%, then it is a substantially different wala modification. Meaning it's a substantially different term. Substantially different condition is satisfied. For you to call it a substantially different, the difference percentage should be greater than or equal to 10%. That's the case. Sir, if it is substantially different, what to do? Sir, if it is substantially different, the answer to this is yes. When does it become yes? The percentage is greater than or equal to 10%. When it is no, when it is lesser than 10%. Yes. If it is the difference is greater than or equal to 10%, then you have to do something called extinguishment accounting. If it is less than 10%, you will do something called modification accounting. Okay. How these two works, I have called out over here. Okay. You have already studied this, whatever words would make sense. Otherwise, let's do a thing. Let's probably apply this first in problem and then maybe come back to the chart. Maybe it will be helpful for us to read. Okay, first maybe once for those of you who would have revised, probably it might help you. One quick overview I'll give you. What happens first, we'll do modification accounting, then we'll take care of it. So find out the difference percentage. If the difference percentage is less than 10, then we do something called modification accounting. So in modification accounting, how does it work is, normally I told you to do this debt restructuring plan and all, borrower may have to pay some money to the bank, right? So whatever money you have paid, adjust it against the financial liability. Okay, so whatever financial liability you have currently, deduct that from that. Then you have to find out. So obviously the cash flows have changed, means IRR would have changed. At old terms, old IRR would have held good. Now the terms and all have changed, cash flow has changed. That means you have to find out the new IRR. Okay, new IRR is what? The rate at which the present value of future cash outflows is equal to financial liability ka balance on the modification date after adjusting fees. Okay, so then based on this new IRR, again you will prepare a new amortization table. That means here you have to prepare two ACM tables. Okay, so I know that some of you would have got it, some of you would have not got it. Let's do a thing. Let's take up one question. I think we have question number 81 here, if I'm not mistaken. One second, let me find that. Where is it? Finding the question only here is big drama. Okay, this is your modification accounting. So we'll do question number 82. Okay, all right. On 1st January 20X0, XYZ company, they've issued 10-year bonds for 10 lakh rupees, bearing interest rate of 10%, payable annually. Interest you have to pay annually. Bonds are redeemed on 31st December 20X9, obviously 10 years. From here to here, 1st January 20X0 to 31st December 20X9, if you count, you'll obviously get 10 years. Okay, these bonds are redeemable at 10 lakh only. So you're redeeming at par itself. No costs of free are incurred. So transaction cost is not there. So if transaction cost is not there, then more or less market rate and effective interest rate will be same. The effective interest rate therefore is also 10%. So market, obviously we have issued this bond at market rate only. So we have not done any extra goalies and all we have not given. So transaction rate, market rate, effective interest rate, all are same here. On 1st January 20X5, meaning after 5 years, X Limited and the bond holders agree for some modification. So whenever they use the word modification, don't immediately do modification accounting. No. Modification here simply means amendment, change, alteration. All right. That modification could be a substantially different modification or it could not be a substantially different modification. Okay. So just because you see modification word here, don't straight away start with modification accounting. No. You have to test always. Okay. So they've done some alteration. What is our alteration? After 5 years, no further interest payments are made. Whatever interest we are paying, we have stopped. Oh, unfair, no? Okay. The bonds are redeemed at the original due date. On 31st December 2009 only you will redeem. But originally, you had to pay 10 lakh rupees. Now check what are you paying? You're paying 16 lakh. That's the reason you're telling the bond holders, maybe you're facing cash flow problem. So you told the bond holders, I will not pay interest to you going forward. At the end of the term, I will redeem these bonds at a premium. Instead of paying 10, I will pay 16. So that's what they've agreed upon. Okay. Legal and other fees incurred is 50,000. Obviously, you have to rewrap the documents, etc. So you have incurred some legal cost of 15,000. For this, you need to do the accounting. Okay. All right. So these are big problems. One trick is simple. Even if you don't understand the whole problem, because I do understand that some of us would have started studying very late. We don't have much time. Okay. This is very important. You should not miss out these concepts, especially from these topics. But still, nonetheless, if you have got into those sort of tricky position, the way you need to approach exam is at least whatever you are aware of, put up working notes for that. You'll get 1 or 2 marks at least. So you'll not lose full marks. You'll at least get 1 or 2. That is always better. Okay. So here, simple. Some modification is done. So first thing is, on the modification date, we need to find out carrying amount of financial liability. And how will you get carrying amount of financial liability? Original ACM table. That we are all comfortable. First, let's do that. So first, initial measurement. Here transaction happened at market term only, correct? Because interest rate was 10%, effective interest rate was also 10%, market rate is also 10%, correct? That means what, sir? Initially, you can recognize financial here. What, sir? We are doing accounting from the company perspective. Company has issued bond. That means this is a financial liability wala accounting because company has a contractual obligation to pay cash, right? So since transaction has happened at market terms, you can record financial liability initially at transaction price itself. So the opening balance of financial liability will be 10 lakh only. You can book the interest charges. This is the effective interest rate 10%. So 1 lakh. All right. Repayment every year. How much are they repaying? Principal you will repay at the end. Every year you have to pay interest. Interest is how much? 10 lakh at 10%, which is 1 lakh. So first year ka closing balance is also 10. Second year also 10. Same thing. If you just check or if you are smart enough, you will not even put up this table. Simply you will write carrying amount of financial liability at when the modification happened after 5 years. At the end of year 5 is straight away 10 lakh. Because everything same, no sir. Actual interest rate same, effective interest rate same. So that means even if you calculate, no, whatever is the opening balance, that only will become closing balance. And at the end of 10th year, you will repay 10 lakh and this final balance will become 0. Okay. So that means this particular table is not even required to be presented. Still study material is given to you probably to prove that both will get you the same answer. So first working note is to find out the carrying amount of financial liability on this alteration date, which is what? 10 lakh rupees, which we have got. Okay, sir. All right. Now we need to test whether this modification or alteration what they have done is substantially different or not. For that, we need to have percentage. And to find out percentage, we need to compare two things. One is this existing carrying amount. Then you have to find out what's. We have to find out the present value of cash flows. Under what, sir? Under new terms. Find out the, because obviously terms have got changed, no? So under the new terms, find out the present value of cash flows. Using what? Using old rate itself. And old rate is what here? 10% itself. So discount factor, you will use 10% only, but cash flow, you will take it under new terms. That you try to find out. Okay, that's what they would have put up in the next line. So under new terms, what we have to do? In fact, this you can do it in one line. So this is the bond. So the cash flow will be only towards interest and principal. So the interest, are you making any interest payment? No, interest payment is nil. So payment only is nil means what is the present value of cash flows? That is also nil only. The only thing you are paying is what, sir? Principal. That too under new terms. Under old terms, you have to pay principal of 10 lakh. But under new terms, you are paying a principal of 16 lakh. And 16 lakh when you will pay? You are at the end of 5th year now. So 5 years is already over. You will make this payment at the end of 10th year. So year 6, year 7, year 8, year 9, year 10. So you will make this payment after 5 years. So should I take PVA upon? You will take PVA. PVA means many years ka discount factor put together. You will take that when you are making the payments every year. The 16 lakh you will make the payment only once. That means you will take PVIF at what? 10%. For what? For 5th year. So do 1 divided by 1.1. 1, 2, 3, 4, 5 equals to button 5 times if you press my calculation showing 0.6209 into 16 lakh. That gives us how much? My calculator showing 9,93,474. So present value of cash flows under the new terms that I have got is 9 lakh something. Yeah, 9,93,474. That's all, sir. No, 1 second. Hang on. So what and all we need to consider? Present value of future cash flows under new terms. Under new terms, are you paying some extra money? Yeah. You incurred some legal cost and all, right? So how much legal cost you incurred? I think they gave in the question. No? Legal cost you are incurring is 50,000. So you have to find out present value of this, sir. Sir, you paid this 50,000 now only. That means it is already there on present value term. So if you add this, what are you getting? You're getting totally 10,43,474. That's what they've written here. So present value of cash flows under new terms by using old rate is 10,47,374. Okay. So this is one. So we wanted two things. This is the present value of cash flows and existing value of financial liability that ACM table gave us. So find out the difference between these two. 10 lakh and 10,43,000. If you find out the difference, what is the difference? Difference is 43,474. These two come minus. Yes, we don't want difference amount. We want the difference in, this is a difference amount. We want it in percentage. How do you get that percentage? 43,474 divided by original. What is the original value of financial liability? 10 lakh into 100 euro. So this is basically 4.34%. That's what they've got. They've rounded it off to 4%. Yes. Now, sir, what is the meaning? Right? You do the comparison and you find out the differential percentage. If a differential percentage is greater than or equal to 10%, if it is 10% or more, it's a substantial modification, meaning it's a substantially new term for which you will do extinguishment accounting. But here it is greater than 10%. It's 10% or more or lesser. It's lesser than 10%. That means therefore here what will you apply? Here you have to do something called modification accounting. So that's what you need to call it. Since the difference is less than 10%, here you will say you will do modification accounting. So under modification accounting, what will happen is first, so did you pay something as, first of all, what is the value of financial liability on the modification date? 10 lakh. Have you paid any legal fees? Yes. This legal fees, you reduce it from the value of financial liability because you have paid legal fees. No, that means you will credit bank, you have to debit something. So you will debit financial liability. So the journal entry you will pass is financial liability account debit to bank. Okay, how much? 50,000, 50,000. That means the value of financial liability will become 9.5 lakh. That's what they told. The revised value of financial liability will become 9.5 lakh. Okay. Now, has the terms same now or the terms have changed? The terms and all have changed, right? That means you can't use old EIR. That means you have to put up a new ACM table by using what, sir? By using new rate. So from 5th year onwards, now you are at the end of 5th year. Hence they started from 1, 2, 3, 4 again. Here 1 stands for at the end of year 5 year. We are at the end of year 5 now. Now we are doing a new ACM table. We are putting. Now the value opening balance of financial liability is 9,50,000. How 9,50,000? From 10 lakh you reduce 50,000 legal fees and it became 9.5 lakh. Now you charge interest rate, and this interest rate will not be at original EIR, it will be at new EIR, which is given in the problem. Check where is the new EIR. Oh, in fact, they have not given. No, so if they have not given, we need to again find out the new EIR. Okay, so the new EIR here they told is 10.99%. They've told, I already showed you how to find out new EIR, right? So basically, new EIR means only simple two payment. Value of financial liability now is 9.5 lakh. After 5 years, it will become 16 lakh. At what rate these two will be equal? That is only your EIR or IR. So assume two rates, okay, discount, okay, I've shown you, you can use formula or the logical method. Most problems in these sort of problems, they will give you EIR because these are already lengthy problems. So they may not ask you extra steps, but it's always good to know, okay. So find out the EIR, which I have already shown you. Here they're saying new EIR is 11%. So and the new interest, in fact, in the new ACM table, you'll calculate the interest at 10.99%. So can I round off, sir? Ideally, it should have been okay. They should have taken it as 11, but okay, nonetheless. So 9.5 lakh into 10.99% if you do, you're going to get interest this much. Payment is nothing. You will make the payment of 16 lakh only by the end of after 5 more years. So that means this is a closing balance. Year 1 ka closing will become year 2 ka opening, and repeat this process. At the end of 5th year, you'll make, at the end of 5 more years, you'll make a payment of 16 lakh and this balance will become 0. So based on this, again, journal entry you need to pass. So that's all as modification account ka draft. Okay. Little writing practice is required. These are not difficult. First time when you read it, no, it obviously looks maybe a little fancy. But 1 or 2 problems if you do, it becomes very, very straightforward. This is okay. You have a proper format and there's not much chance of deviation also. Same thing will be done almost in every problem. Okay. So what is that? Maybe one quick recap we will give on this. What is it? So first check, sir. First of all, debt restructuring means you have done some alterations. You have done some modifications. When they use the word modification, don't do modification accounting. Modification initially in question means simply amendment or some alterations. So whenever alterations are done, okay, you need to find out some percentage, okay, and accordingly the accounting will work. To find out percentage, we need to compare 2 things. What are those? First, on the modification date, find out what is the current value of financial liability. So you would have already prepared ACM, you would have been doing ACM accounting. So your ACM table will give you the current value of financial liability, okay. Then you need another component. What is another component? Since the cash flow, since the terms have changed, cash flow would have changed. So find out the present value of future cash flows under new terms, but by using old rate. Find out the present value of future cash flows under new terms, but by using old rate. Okay. So compare the existing financial liability with this new present value and find out the differential percentage. If the differential percentage is 10% or more, you have to do something called extinguishment accounting. If the percentage is less than 10%, you have to do modification accounting. Modification accounting, how do you do? Okay. First, if there is any legal fees and other charges and all, set it off from financial liability. The journal entry is financial liability to bank. Okay. Since the terms would have changed, now the old EIR will not hold good. You have to find out new EIR. If it is given in the question, well and good. Otherwise, you have to find out the new EIR. Basically, rate at which that 9.5 lakh, the current financial liability value, will be equal to present value of future cash flows. Your present value of future cash flows is only principal that you're paying, which is 16 lakh. At what rate the present value of these two things will be equal? That is nothing but your new EIR, which is 10%. Okay, now you have to find out the new ACM table you need to put up. Okay, so the value of financial liability is 9.5 lakh. Henceforth, interest and all, you'll start looking at new effective interest rate, which is 10.99%. So new ACM table you book, and at the end of 5 more years, the financial liability balance will become 0. Okay, that's all is modification accounting card. Okay, all right. There is also something called extinguishment accounting. We'll also maybe first I'll run through the point and then we will tell you. Okay, sir, if the difference is less than 10%, modification accounting. What if the difference is greater than 10%? If the difference is greater than 10%, you have to do something called extinguishment accounting. Extinguish something means what? Cancelling. All right. So to extinguish something means to de-recognize or cancel. So in extinguishment accounting, what you do is you have to de-recognize old financial liability. Whatever old financial liability or old loan you have, no, you have to cancel. So it's as good as saying you have done a great amount or a bigger amount of modification. So cancel old loan and account it as a new loan. That is extinguishment accounting. Cancel old loan and account it as new loan. Okay. So basically, whatever is the old value, existing value of financial liability, you cancel, de-recognize. Your ACM table will give you existing liability balance, which is, we saw 10 lakh there. You de-recognize that. And you have to recognize new financial liability. How will you recognize new financial liability? Same. Present value of future cash flows. But this is a new loan, no? So don't use old rate. Use the new rate itself. Find out the present value of, obviously the terms would have changed. So cash flow would have changed. So find out the present value of cash flows at new rate itself. Using new rate, find out the present value of cash flows. That present value of cash flows becomes a new financial liability wala loan. Okay. You recognize this. So old one you will cancel. So you will debit that. New one you will credit. There will be a difference. So obviously, sir, when you settle a loan and all, no, you might settle at that price or lower price. So there will be some. So obviously, when you sell a PP and all, you will book some gain loss. No. Similarly, when you do extinguishment accounting, when old loan you're cancelling at one value, but new loan you're accounting at different value. So there will be a difference. The difference will be transferred off to SPL account. This is your derecognition accounting. So it will be treated as a gain loss. It could be a gain or it could be a loss. Doesn't matter. Whatever be the difference, gain or loss, will be transferred off to SPL accounting. Okay. Then what's up? For this new loan, you have to put up again new ACM table and do the accounting. That again at new rate only, so no drama. Here old rate will never come into picture. Everything at new rate only. New effective interest rate itself. Okay. So what about legal fees? And legal fees also you transfer it off to P&L. Sir, is it a transaction cost? No. The bank is charging you that money, no, not for the new loan, but to restructure. If you are asking for restructure, no, so they have to put some extra efforts. They have to analyze your files again, right? So that means that legal fees or whatever fees the bank is collecting from you, right? It is not a transaction cost for the new loan, okay? It is what? It's like more like a processing charges for your existing setup. For them to review your existing files, to redo the work, they are charging that money. Hence, this is not transaction cost. India's 109 guidelines is this is not a transaction cost relating to the new loan. Rather, it is related to old loan, and old loan is already cancelled. That is the reason any fees that you paid here will be straight away transferred off to P&L. But in the old case, no, you did not derecognize financial liability in modification case. That's the reason you adjusted legal fees with financial liability balance, right? Because it relates to the old loan. So here in this extinguishment accounting, new loan is not even there. New loan, old loan is already closed in fact, right? So that's the reason this transaction fees which relates to the old loan, you transfer it off to P&L account. That's all. Okay. So again, just as a recap, extinguishment accounting, what do? Old loan, whatever is the carrying amount of old loan, you will cancel, right? And you will recognize new loan at what rate? Present value of future cash flows at new rate itself. So obviously there will be a difference because both are recognized at different amount. The difference will go off to P&L account. And if there is any legal fees, professional fees, or bankers, processing fees, whatever, this is related to old loan. And in extinguishment accounting, old loan is already cancelled. That means this legal fees will be, it's not a transaction cost relating to new loan, but it is related to old loan. Since old loan is not there, this particular fees and all will be transferred off to P&L account. That's all you have to do. Okay, more or less it's the same. Let's do a thing. Let's apply it in one other question. I think it's 81 or 82 or whatever. 82 was done. So that means we'll run through 81. I think this will be relating to extinguishment accounting. So these are better learned with the help of numbers. So we'll quickly run them by the numbers. On 1st January 2080, XYZ Limited issues 10-year bonds for 10 lakh rupees. Okay. Interest rate at 10%. The bonds are redeemable on 31st December. Same data for 10 lakh only. No cost is there. Effective interest rate is also 10%. So same data that they've used. On January 20X5, meaning after 5 years, some modification was done. Just because they use the word modification, don't do modification accounting. You'll have to check. So this modification simply means alteration. What is alteration? The term got extended to 31st December 20Y1. Hang on. Originally, the term was 31st December 20X9. From 31st December 20X9, it became 31st December Y1. Originally, the term was 10 years. Now it got pushed by 2 more years. It is not Y0, it is Y1. After X9, the year is Y0. After 20X9, it is 20Y0 and then it is 20Y1. That means the term got extended by 2 more years. Okay. So total period of the loan is not now 10, it has become 12. And in that 5 years is already over. So the remaining term is 7 years. Okay. Old term was 10, the new it got extended by 2. That means the total term is 12 years and that 5 years is already over. So the remaining term is 7 years. Okay. Interest payment reduced to 5%. Initially, the interest rate was 10%. As for the new term, interest you have to pay only at 5%. Bonds are redeemable on 31st December 2001 for 15 lakh. Now you are not redeeming it at 10 lakh. You are paying 15 lakhs. Legal other fees is 1 lakh rupees. X determines the market rate of interest on the borrowing is similar. Market rate under the new terms is 11%. Okay. All right. This all is the thing. So first is the same thing. First find out the carrying amount of financial liability on the modification date or on the alteration date. That should have to put up ACM table? No. Since initially the market rate, effective interest rate and actual interest rate was same. So carrying amount of financial liability will be straight away 10 lakh. Right? Even if you put up ACM table, see again they put up and they've got the closing balance to be 10 only. So no point in putting that up. Okay. Second step is what? Same drama. First, you don't know whether this is modification accounting or extinguishment accounting. So first you need to do what? Compare this with another number and find out percentage. What is that other number? Present value of future cash flows under what terms? Under new terms you have to find out, but by using old rate, right? Okay. So now what and all you have to pay, sir? Check over here. Under the new terms of cash flows, you have to pay what is the interest? Bond value is 10 lakh. Interest rate is now 5%. So 10 lakh of 5%, you have to pay interest at the rate of 50,000. That is one. Maybe we'll just check off this. You have to pay interest at the rate of 50,000 every year for 7 years. We already told that. Yes. So since the interest payment is same every year, we can use PVAF. Okay. I think they've given here, or I think they've taken it here. I will check here. Interest payment of 50,000, you have to make it for 7 years. Okay. And you'll discount this at old rate itself. This is your old rate. Okay. So PVAF they've used. That's the only thing. Oh, no. You have to pay principal also. How much principal you have to pay? 15 lakh. Principal pay, you are at the end of 5th year now. This principal is payable at the end of 12th year. That means you will make this 15 lakh payment after 7 years. So this 15 lakh payment you will make at the end of 7 years. So 7th year ka discount factor you take. This is PVIF you will take, meaning 7th year ka discount factor. This you will take for all the 7 years put together. So PVAF. Okay, fine. And there's one more legal cost of 1 lakh that you have incurred. So present, it's all you paid this now only. So that means it is already there on present value. So present value of this is 1 lakh itself. So these two present value on roll terms will become 11 lakh 13,158. Okay, we got that. Compare this with what's carrying amount of original loan or carrying amount of financial liability on the modification date, which is 10 lakh. Existing balance is 10 lakh, but the present value of future cash flows under new terms by using old rate is 11 lakh 13. So what is the difference? 1 lakh 13,538. Now you have to find out difference percentage. How do you find out the difference percentage? Difference amount divided by original amount into 100. Difference amount is 1 lakh 13. Original amount is 10 lakh into 100. If you do, you're getting a difference percentage of 11.32 percentage. So if the difference here, the difference is greater than or equal to 10%, that means here what you have to do? You have to do, obviously, you have to do modification wala accounting. Modification, rather you have to do here extinguishment accounting you have to do. So what is the simple rule of extinguishment accounting? Let's write the rules just for our memory sake. First rule is cancel old financial liability. Old financial liability ka current book value is 10 lakh. So you'll de-recognize it 10 lakhs. Then what you'll do? Recognize new financial liability at what? At the present value of future cash flows using what? Old rate? No, but we're using new rate. So you already found out present value of cash flows, but you have done it at old rate. Now same present value you found out using new rate. What is the new rate they told over here? It's the same modification. Market may the new terms carry an interest rate of 11%. Now discount the same thing at 11%, but don't consider this legal cost because legal cost is not a transaction cost for new loan. It is related to old loan and old loan is already cancelled. So leave that out. Only this 15 lakh and this 50,000 you discount it at 11% now. You're going to get 722 and 235. Do not bring in legal cost. Okay. That means the value of the new loan will become 9 lakh here. They've told 958,097 and carrying amount of the old loan is 10 lakh. What is the journal entry you will pass here? This is your financial liability loan. I'll write old loan, which will be debited. You need to cancel, so you'll debit at 10 lakh to what? To financial liability loan. This is a new loan. You'll recognize it at 958,097. That means obviously there is a difference. 10 lakh minus 958,097. How much is that difference, pa? That difference is 41,903. That will be the exchange gain, which will be transferred off to P&L. This is one. Okay, that's all. No, there's a legal cost also. For legal cost, the journal entry is legal cost account debit to bank and then SPL account debit to legal cost. Or directly can I pass this entry? SPL account debit to bank. This is for your legal cost. And how much was that legal cost you incurred? 1 lakh. Yeah, legal cost here they told is 1 lakh. Okay, so basically 1 lakh is the loss and 41,000 is the gain. So net loss may what? Due to this transaction, what is the net loss? 1 lakh is a loss, 41,903 is the gain. So net may you are getting a loss of 58,097. That's what they must have presented over here. At the end may, if you just check somewhere, net may there is a loss. Due to this, there is a loss of 58,097. That's what we got here. Okay, sir. And on this new loan, you have to do new ACM table and repeat the process. That they've not asked. Most probably they'll not ask also. Okay. If at all they ask, one new ACM table you need to put up for another 7 years, and that will be the end of the draft. So this is about your extinguishment accounting. Okay, sir. Yeah, this is also done. 81, 82 is also done. Okay. Then some extra concepts are there. We will do that. Where is it? This is done. Okay. Next is derivative will go. Or maybe once I just look through the problem. Hang on. Okay, sir. And the next concept is again quite important one, which is derivative. or 1 second, and just see if any problem is left out. 106. Okay, maybe we'll do of this and then maybe take up derivative. An entity purchases a debt instrument of fair value 1000 on 15 March, okay, and measures the debt instrument at FVT OCI method, fair value through other comprehensive income. So they're using OCI method. So initially you'll measure it at fair value, initially and subsequently you'll measure it at fair value itself. That means initially when you buy it, it's financial asset account debit to cash or bank 1000. Okay, this is on 15th March. Okay, the instrument has an interest rate of 15%, 5% on contractual term. Okay, has 5% effective interest rate. That and all is okay. At initial recognition, the entity determines that asset purchased is not credit impaired. There is an impairment concept also, which is not much exam relevant. Impairment concept, when we did a financial asset, we discussed in detail. We almost spent 1 hour for it. Yes, but it doesn't have much exam relevance. I told, because I'll also discuss what is the exam relevant point. I'll discuss with you a little later. Leave that. On 31st March, at the end of the year, the fair value of the debt instrument has decreased to 950. We know if you're following FVT OCI method, at every reporting period, you have to measure it at fair value. When you bought it, it was 1000. Now it has become 950. That means there is a fair value loss of how much? There is a loss of 50 rupees. Okay. As a result of market change interest rate, the entity determines that there has not been any significant increase in credit risk since initial recognition, and expected credit loss measured at an amount of 12 months ECL amounts to 30 lakh. Okay. This ECL is nothing but the impairment loss that they're talking about. So a little bit more about, I'll talk about it after later. So there is an impairment on financial asset. You also calculate something called impairment. When we studied Ind AS 36, I told on financial assets, you don't calculate impairment loss because Ind AS 109 only gives the treatment for it. So here they're saying ECL stands for expected credit loss. Okay. All right. So they are saying on this financial asset, there is a expected credit loss of 30. So that is nothing but your impairment loss. So what they're trying to say here is, sir, when you bought it, it was 1000. At the year end, it has become 950. So there is a loss of 50. Sir, out of this loss of 50, no, entire 50 is not fair value loss. 30 is your impairment loss and 20 is your fair value loss. Since you're following FVT OCI method, fair value loss will go off to OCI, but impairment loss will go off to SPL only. So don't transfer entire 50 as a fair value loss to OCI. Out of this 50, 30 is an impairment loss and 20 is a fair value loss. That's what you need to do over here. Okay. All right. So on the 31st March, what do you have to do here? You have to reduce financial asset by 50. So you credit that. And then you'll recognize impairment loss of 30 that will be transferred off to SPL, and fair value loss, which will be recognized in OCI to the extent of 20. Okay, so that's the thing. Okay, so entire loss, don't book it in OCA. 30 is an impairment loss which goes off to SPA. Okay, then on 1st April, entity decides to sell the instrument for 950. Okay, it is valued at 950. You sold it for 950. So the journal entry will be bank account debit to financial asset 950, 950. That's all. Okay, drama. Actually, one more should have been passed. Once the instrument is sold, no sir, these debt instrument, no, this we call it as reclassifiable OCIs. This debt instruments which are measured at FVT OCI, okay, they are reclassifiable OCIs, meaning once the instrument has been derecognized, whatever is OCI balance, no sir, you have to transfer it off to SPL. Okay, so here how much is OCI balance? Here OCI balance was 20, no, right? So that has to be released back into P&L, which study material is not doing for some reason, but in my opinion, that also should be done because these debt instruments are reclassifiable OCIs. So once that instrument is derecognized, whatever OCI balance is there, whether loss or profit doesn't matter, you have to release it into P&L. Okay. If it is non-recyclable or reclassifiable OCIs, then if that instrument on which you have got this OCI, if it is derecognized, then it will be transferred directly to retained earnings. If it is non-reclassifiable, it will go up to retained earnings. If it is reclassifiable, it will go up to SPL. And each standard will tell what is reclassifiable and what is non-reclassifiable. You have to remember that. Okay, and accordingly do this particular treatment. So this is all about 106. Okay. Next, or maybe I'll take off this question also, financial guarantee wala question. This was an RTP May 2021 wala financial guarantee wala question. Then maybe we can take up a derivative portion. Financial guarantee. So what is this, sir? So simple, sir. There is a subsidiary company. They approached ICICI Bank. Okay. Saying they want a loan. ICICI Bank told no problem. The subsidiary company told they need a loan of 100 crore. ICICI Bank told no problem. We will charge 15% interest rate. Okay. Estimator told you that is too much. I can't bear so much and all. Okay. ICICI Bank told you have a parent, P Limited. If P Limited is ready to give guarantee, if P Limited is ready to give me guarantee, then I will make the interest rate for you at only 10%. Okay. So that's what ICICI Bank is getting. subsidiary company wants the loan. So the ICICI Bank wants to charge 15%. But if parent on the loan, no, third party generally gives guarantee. So bank is saying if your parent company is ready to give me guarantee, ICICI Bank, if they're ready to give guarantee to the bank, then the interest rate ICICI Bank will charge only is 10%. Let's assume that is the case. Okay. This we call it as financial guarantee. Financial guarantee. For this financial guarantee, what accounting needs to be done by the parent is what we need to worry about. Okay. Now think about it, sir. There's a transaction happening between S Limited and ICICI Bank. Parent should have chumma kept quiet, no. Unnecessarily they gave guarantee. Now what happens, since the parent has given guarantee, if S Limited defaults the loan, if subsidiary doesn't pay the amount, then parent has to pay the money. Correct or no? That means one extra obligation parent took unnecessary. By giving this guarantee, parent took one extra obligation. That means one extra accounting becomes necessary. Okay. So that is nothing but your financial guarantee wala accounting. Okay. So how to do that accounting? We'll learn it with the help of one problem itself. Some theory is there. Let's learn it with the help of numbers itself. It is a lot easier to relate with. Okay. So let's take up this particular question. You got the background, right? Yeah. On 1st April 2021, Sun Limited guarantees 10 lakh loan of subsidiary Moon Limited. So Sun is the parent, Moon Limited is the subsidiary. Okay. Parent is given guarantee on subsidiary ka loan. Bank ka name is STD, something they're saying, for 3 years and 8% interest rate. So actual interest rate charges 8%. Interest payment are made at the end of each year and principal paid at the end of the loan. If Sun Limited had not issued guarantee, the bank would have charged Moon interest rate of 11%. Because of guarantee, their bank is charging 8% interest. If guarantee was not given, interest rate would have been 11%. Okay. On 31st March, there is 1% probability at the end of the year. Guarantee is given on 1st April 2021. At the end of first year, there is 1% probability that Moon Limited subsidiary company may default on the loan. They may not pay the loan. The next 12 months. If Moon Limited defaults, Sun Limited does not expect any recovery. So 100% going up. Okay. So if subsidiary default means full parent only has to pay. Alright, next year, 31st March 2023, there is 3% probability that Moon will default on the loan. Okay. And if Moon Limited defaults, Sun does not expect any recovery. 100% gone. So you need to give the accounting treatment of this financial guarantee in the books of Sun Limited. Okay. For all the years. So ICA is presented in some way. First, I'll give you some theory pointers for this, or I've already written. You can just check. So financial guarantee. Now parent is given unnecessary guarantee. So they put some extra obligation on their head. Right. So they put some extra obligation on their head means they have to recognize something called financial liability. Because they have an obligation. Whenever you have an obligation, you need to recognize financial liability. That financial liability ka name is financial guarantee. Okay. So initially financial liability was measured at fair value. And at every reporting period, this financial liability will be measured at fair value or the loss allowance, whichever is higher. How to calculate it? Let's see over here. It's a very simple calculation. Loan term is 3 years, no? Right? Sir, what is the actual interest rate subsidiary is paying on the loan? 10 lakh is the loan amount for which 8% is the interest charge. That means they're paying only 80,000. This is due to parent giving guarantee. If parent had not given the guarantee, the interest rate would have been 11%. That means the interest amount would have been this much. 10 lakh, 11%, 1 lakh 10. Because parent gave the guarantee, subsidiary is able to save some interest, correct? How much savings they're able to do? They're able to save interest of 30,000 every year. Yes. So now what did I say? Financial liability is nothing but financial liability. Parent has to book one financial liability and the name of the financial liability is financial guarantee. Initially, it's measured fair value. What is a fair value? Fair value is not, there is no cash flow here. No. Generally, we find out fair value, how present value of future cash flows. Here, there is no cash flow because it's only guarantee given amount. Yes. So the present value of future savings, becomes the fair value. Okay. So every year subsidiary is able to save 30,000. So find out that, sir. Initially, you are recognizing. So loan term is 3 years. So the 30,000 they'll be able to save for all the 3 years. So find out the present value of that. So we'll use PVAF because every year they'll save. That will be 73,311. So initially guarantee amount will be measured at 73,311. That is nothing but instead of present value of cash flows, here it is present value of interest savings. That's all. Okay. And you have to pass one entry. What is that? Financial liability means obviously it will have credit balance. So you will credit. What you will debit? Nothing. You can't debit bank and all. So who has given guarantee? Parent and subsidiary. So the relationship is like that. You know this already. If parent is giving guarantee means parent will treat it as an investment made in subsidiary 73,311 to financial guarantee. So this is a journal entry. Initially, the parent company will pass. Okay, this is the initial measurement of financial guarantee. Straightforward. And at the end of every year, financial liability means you have an obligation. So the end of each year, you need to remeasure. Okay, how does it remeasurement now? Now, first year over. Now, at the year end, 1 year is already passed. Now, again, the same concept. How do you find out? Present value of future savings. So 1 year is all, you are at the end of first year now. So 1 year is already passed. So again, you need to find out the present fair value of financial guarantee. How do you find out that? present value of future savings. Future savings now is 1 year is already over. That means 2 more years is pending. So 30,000 you discount it at what? 11% for 2 years. Okay, so the interest amount will be, the fair value will be 51,375. This is the fair value at the end, fair value of guarantee at the end of first year. But at the end of at every reporting period, no, financial guarantee will be measured at fair value or loss allowance, whichever is higher. What is this loss allowance? Loss allowance is default percentage. How much loan amount was given? 10 lakh. They told at the end of first year, there is 1% probability, here, there is a 1% probability that they will default. So 1 lakh ka 10 lakh ka 1% you do. And if they default, can we recover anything from subsidiary or 100% gone? 100% gone. Hence multiply by 100%. If they say we can recover 80%, then you'll write into whatever is the loss percentage there. Here 100% is a loss, no? So hence 100% you do. Okay. Most of the problem it will be that. So that means this is the loss allowance. So the financial guarantee will be recorded at 51,375 or 10,000, whichever is higher. Which is higher? 51,000. So you have to record or you have to show the guarantee in your balance sheet. Financial liability or financial guarantee you have to show in your balance sheet at year end at 51,000. But initially you already recognized at 73. You already shown at 73, but you have to recognize now at only 51. So from 73 you have to bring it down. So guarantee amount you need to reduce, right? Financial guarantee is a financial liability. Liability, if you are reducing, means liability account should be debited. What you will credit? SPL. So the difference will be transferred off to SPL. So these two difference is how much? 21,936. That 21,936 will be transferred off to SPL in the first year. This accounting you have to do for all the 3 years. Okay. Second year, now again at the end of let's say first year over. No, now let's come to the this end of first year. Okay. Now if we come to the end of second year, if you are at the end of the second year, means 1 more year loan is pending. So 1 more year interest saving can be done. So find out the present value of annuity factor. Here actually it's not annuity factor, it's PIF in fact, because only 1 year is there. So 30,000 discounted at 11%. You will get 27,027. That is the fair value. Then loss allowance. In the second year, there is a default percentage of 3%. So 10 lakh into 3% into 100%. Why 100%? Because subsidiary defaults, we can't recover anything. So loss allowance amount is 30,000. So this or this, whichever is higher, which is higher, 30,000. So guarantee amount will be shown in the balance sheet at 30,000. But currently you are showing it at how much? 51,375. You're showing it at 51,375, but you have to show it at 30,000. That means again you need to reduce by how much? 21,375. So that 21,375 again you'll pass the same entry and transfer it off to SPL in second year. Okay, third year, you are at the end of third year. So will there be any present value of future cash savings? No. That means fair value is 0. Loss allowance is also 0. So higher of the two most amount is also 0. That means guarantee amount you should also show as 0. But currently you are showing guarantee amount of 30,000. That means at the end of the loan term, whatever is the guarantee amount, entire guarantee amount, you transfer it off to SPL. This they have not asked. I've just shown it for your reference. Okay. So that's where you'll close the financial guarantee wala amount. Okay. Yes. This was about the guarantee wala concept. So just to sum up, it is simple. Instead of present value of future cash flows, you calculated present value of future interest savings. Okay, that you calculate, or loss allowance, whichever is higher. Loss allowance and all, you'll get it only at the end of the year. So hence initially, financial guarantee is measured at fair value. Fair value, how do you get? Present value of future interest savings. And the end of each year, you have to calculate fair value and loss allowance, whichever is the higher you need to take. And how do you get fair value at the end of each year? Present value of future cash, future interest savings, and loss allowance, take the loan amount and they'll give you the interest rate, interest percent or loss percentage, multiply that and get it. Higher of the two will be adopted. Accordingly, guarantee amount you may have to increase or you may have to reduce. Doesn't matter whether you have to increase or decrease, you will transfer it off to SPL itself. So that's all is guarantee amount ka whole drama. Okay, so that was also we have covered. Okay, so financial guarantee over, this is also over. Now I'll give you a quick walkthrough of a derivative, then we'll do a few questions relating to that. Okay, so derivative means as such that contract does not have any value. In fact, if you want to call an instrument or a contract as a derivative, it has to satisfy 3 features. 1, it derives its value from an underlying asset. It gets its value from something else. Second, initial investment is either low or nil, and settlement is always at a future date, and that settlement could either be a gross or it could be a net settlement. Okay, so what is this again? Sir, let's say, excuse me, you want to purchase Infosys futures. So you must be trading in futures and options and all, no? Yes. Let's say you want to buy Infosys futures. Okay. Now you tell me that futures as such, does it have value? No. Its value is dependent on Infosys share price. So that is what is derivative ka first feature. that derivative instrument will not have any value. It will derive, hence the name derivative. It will derive its value from something else. Now something else could be shares, something else could be gold price, commodity price, currency price, doesn't matter. It is deriving its value from something else. That is the first feature. Second, the investment for these sort of contracts is very nil or very low or zero also. Settlement of this, you have entered the contract now, but you will settle this in future, either as a gross or as a net. We'll see what is this in one problem. Okay, if all these features are satisfied, then we do derivative accounting. Okay, sir. Now derivative accounting, sir, for derivative you always do FVTPL accounting. Okay, because there is no contractual cash flows here and all, so it is you always do FVTPL accounting. And derivative, no sir, either could be this derivative here only, right? Derivative could either be a financial asset or a financial liability. Because when you enter into these sort of contracts, either you can end up making some gain or you end up making some loss. If you are in the gain scenario, then you will book it as financial asset. If you are in the loss scenario, you will book it as financial liability. Hence, if you look at the definition of financial asset and financial liability, both the things had derivative, because derivative could either be an asset or it also could be a liability. That's what it is. Simple accounting of derivative is measure it at fair value. Okay, FVTPL method. Okay, means initially it will be recognized at fair value. At each reporting period, you will recognize it at fair value, and that fair value gain loss, since you are following FVTPL method, the fair value gain loss, all those fair value gain loss will be transferred off to SPL account itself. Okay, one more thing you need to remember is on the trade day, on the day you enter into this contract, most of the derivatives you will not pass any journal entry because it will not have any fair value. Let's say you enter into a forward contract, right? So the day you enter, is it a profit for you? No. Is it a profit for the seller, other party? No. On the day you enter, we say stock market is a zero sum game, right? So when you enter into these sort of contracts, it is on the day you enter, it is neither profit for one party nor loss for another party. For both the parties, it is neither profit nor loss. That means it does not have any fair value. On the day you enter into contract, there is no fair value. After that, due to share fluctuation or currency fluctuation, one party will end up making some profit, another party will end up making some loss. So, but the day you enter in the contract, there is no fair value at all. Hence, we don't pass any journal entry. However, derivative in the form of options. Derivative could be either forward, options, futures, swap, etc., etc. For options, no sir. Okay, there will be options premium collected. Sir, in case of forward, futures and all, no sir, you cannot back out of the contract. If you enter into a forward contract, let's say for 3 months, after 3 months, compulsorily you have to honor it. You have to settle it. Doesn't matter whether you are in gain scenario or loss scenario, compulsorily you have to go through with the contract. You cannot back out. But in case of an option, name itself is saying option. So in case of option contract, you can back out. Alright, one person can back out. So if it's obviously, when do you think they'll back out? When it's a loss scenario. That means for other party it will be loss, no. Hence in options, no, they will collect something called options premium initially itself. So initially itself, one person will collect the premium. So one person has to pay the premium, one person will collect the premium. That means obviously for the person getting it, it will be a financial asset. For the person paying it, it will be a financial liability, like that. Okay, so that's the reason for options you will record, there will be passed some journal entry. So when you paid, the journal entry will be financial asset account debit to bank account. When you receive it, the journal entry will be, rather I told I think ulta. When you paid, for the person paying it, the journal entry will be financial asset or derivative financial asset account debit to bank. For the person receiving it, it will be bank account debit to derivative financial liability. And thereafter go on doing FVTPL accounting. You may get further gain or you may get further loss. That's all. Okay. But do remember, mostly you will not get options in the problem. In majority of the problem, it will be either a forward or a futures. So that means in the contract date, you will not pass any journal entry. And each reporting period, you measure it at fair value, and any gain loss relating to this will be transferred off to P&L. That's all this is. Okay. So let's do a thing. Let's take up a question relating to this. Much easier to understand with the help of a question. I think we'll go for 92. Where is 92 now? This one. On 1st January 20x1, Samco agreed to purchase US dollars 20,000 from JT Bank on futures. So they entered into a future contracts. Okay. So to buy 20,000 US dollars. Why? Maybe they have a foreign debtor. Okay. Or maybe they have a foreign creditor, this company, and they have to purchase, they have to settle that foreign creditor in dollars. That's the reason first they have to purchase dollars and pay him. That's the reason they've entered a contract, a futures contract to purchase dollars. How many dollars? $20,000 on 31st December. Okay, you have entered the contract on 1st January, but you'll actually purchase the dollars only on 31st December. So settlement will happen on 31st December, 1 year later. At 68, in forward, these sort of contract, no, settlement will happen in future. But at what rate you will buy or sell or whatever, rate will be fixed on the date of contract itself. On 1st January itself, you are telling, I will buy $20,000 from you by paying 68 rupees per dollar. On each dollar, we will pay 68 rupees. So the rate is already fixed. Okay. Alright, Samco did not pay any amount upon the initial entry into contract. So that means initial investment is 0. Settlement is on a future rate. Initial investment is 0. This future as such has a contract? No. It as such has value? No. It derives its value from dollar ka fluctuation rate. That means derivative ka all the features are getting satisfied. So it's a derivative accounting. Samco is a listed company, blah, blah, blah. They're doing it on a quarterly basis. Following the principles of India's 9, you need to do the accounting. For the purpose of accounting, please use this particular thing they're saying. On 31st March 20x1, this is the end of quarter 1. The rate has become, in fact, they have actually in the study material, they have directly given loss. Okay. Better approach is to give the dollars. Okay. Let's take this and rework this number. It's easier. So let's say $1 has become 66.75. Now things, you already entered into a contract. You have entered into a future contract saying you will buy the dollar at 68 rupees. Okay. Now we are at the end of first quarter. Now $1 they are saying has become 66.75. 66.75. You have a happy face or you'll have a sad face? You'll have a sad face. Why? Sir, you have made a contract to purchase $1 by paying 68 rupees. To buy $1, you have to give away 68 rupees. If you had not made the contract, no, from the market, you could have purchased $1 just by paying 66 rupees. If you had not made this contract, $1 you could have purchased just by paying 66. That means because of this contract, you are making extra loss. How much is that loss? You have to buy it at 68, but in the market, it's available at 66.75. So 68 minus 66.75. How much is that, sir? 1.25 is a loss on $1. How many dollars you have? 20,000. That means you are making a total loss of 25,000. That's how they're given. The total loss is 25,000. So that means it's a loss position. So it's a future contract. So is there any premium collected? No. On the day you enter into a contract on 1st January, will you pass any entry or no entry? There is no fair value. That's the reason we don't pass any journal entry. At the end of first quarter, you ended up making a loss? Yes. If it's a gain, means you book derivative financial asset. Loss means derivative financial liability. So you'll credit derivative financial liability 25,000. FVTPL method, no. So what will you debit? P&L account or SPL account. This is the first quarter. Right? Okay, sir. Second quarter, the rate has become 67.25. Again, just check. You already freeze the rate. You have to pay how much? $1 you will buy by paying 68 rupees. But if you had not made the contract, you would have purchased this just by paying 67.25. Correct? That means again you have a sad face. Say how you're paying how much? 0.75 extra on $1. So for $20,000, how much is the loss? 15,000 is the loss. That means the loss is 25,000. Again, extra loss. No. The total loss now is 15,000. But quarter 1 may you already booked the loss of 25. Is the loss really 25 or it is just 15 now? It's only 15. That means what? Liability value you need to reduce. How do you reduce it? Liability as credit balance. To reduce, you will debit. So derivative financial liability account debit 10,000 because from 25 you have to bring it to 15. So actual loss is not 25. You thought it is 25 in quarter 1. Quarter 2 my total loss is only 15. So you have to show derivative liability only at 15. But currently it is shown at 25. From 25 if you have to bring it to 15, the reduction is 10,000. So derivative financial liability account debit to SPL or P&L 10,000 rupees. By passing this entry, derivative financial liability balance will become 15,000. Okay, this was second quarter. What about third quarter? At 30th September, 12,000 rupees. In fact, they've given positive. Why? The rate has become 68.6. Okay, now feel happy. Why? Sir, you have made a contract through which you can buy $1 just by paying 68 rupees. If you had not made the contract, no, you had to pay 68.6 rupees to purchase $1. To purchase $1, you had to pay 68.6. But now, because of the contract, you'll only pay 68. That means you went to gain scenario. So on $1, 0.6 gain. So 20,000 will be 12,000 gain. That's how they've written plus 12,000. So it's a gain. Loss means derivative financial liability. Gain means derivative financial asset. But you already booked the loss. Is it a loss now? It's a gain. It's a gain. That means whatever loss you booked, you need to reverse. So the next entry will be derivative financial liability account debit. How much is the derivative financial liability balance? 15,000. And then you will book derivative financial asset account. How much is the gain? 12,000. To what? To P&L or SPL account 27,000. That's what they passed away. Okay, this for the third quarter. Okay. Last will be the last one. On the spot rate on 31st December, $1 actually has become 66. Oh, sad face, no? Because you made a contract. As per your contract, on $1 you have to pay 60. To buy $1 you have to pay 68. If you had not made the contract, you could purchase $1 just by paying 66. That means you are making a loss of $2 rupees loss on $1. So that means how much on total dollars 20,000? How much is the total loss? 40,000 rupees. But you already booked the gain. This 40,000 is actually a loss. So what do you have to do now? This is a settlement, right? So this this derivative could be a net settlement or a gross settlement. Study material is assuming net settlement and passing this journal entry. I'll also show the entry for gross also. Just check. Net settlement means what, sir? All this derivative financial asset and derivative financial liability you need to close. Because in case of derivative, no, you're entering into these contracts not really to purchase dollars. but to play around, to speculate on this exchange rate ka fluctuation. Okay, so but speculate you are getting into this transaction. So most of the derivative transaction will be settled on net basis. So what you'll do, you already booked derivative financial asset, cancel that by 12,000. What is the actual loss? You're suffering an actual loss of 40,000 that you need to settle. On the settlement date, if you have made an actual gain, you will receive it. If you made an actual loss, you need to settle. Here you made an actual loss of 2 per dollar, and on $20,000, the loss is 40,000 that you need to pay. So bank account or cash account, you will credit by 12,000. Okay, everybody, right? Journal entry is not matching. So basically your loss is P&L में 52,000. That's all the same entry over here. Okay, balancing figure is loss. How lost 52,000? At the end, actually you suffered a loss of 40,000, but you already booked an asset. No, you booked an asset of 12,000. That asset also you need to write off. So that is also a loss. So 12,000 is asset write off loss. 40,000 is actual loss which you have suffered. So hence the total loss is 52. Hence you have debited P&L by 52,000. Okay, or simply you can credit. You need to credit cash by 40,000 because you have to settle. Whatever asset, this liability account is already closed. Asset account is still remaining. Close it by crediting it. Balancing figure, debit of P&L account. This is on net settlement. On net settlement, whatever gain you have made, you will receive. If you have made any loss, you need to settle like that. However, if you are doing gross settlement, then the journal entry you will pass is bank account debit. Meaning if you use this transaction and actually purchase dollars. Net settlement means only gain and loss settlement will happen. Gross settlement means you will actually give Indian rupees and buy off dollars. That's why we call it as gross settlement. So dollar in the cash in the form of dollars will come in. Cash in the form of INR will go out. So maybe instead of bank, I'll write cash only. It's easier. So if it's a gross settlement wala transaction, then you'll write cash account debit. This is what? US dollars. Okay. How many US dollars? 20,000 US dollars will come in for you. Okay. At what? And what is the spot rate of each dollars? What is the worth of each dollars they told? You will do this transaction only on 31st December, no? And the worth of $1 is 66. So that means you will write dollar ka value is 66. So 20,000 into 66 will be how much? So dollar value is 13,20,000. Like this. But to buy this dollar, you have to give away Gandhi notes. So you'll write here to cash account. This is your Indian rupees. How much of Indian rupees you need to give? $20,000 you need to buy means you already made a for a future contract and you freeze the rate. $1 you'll buy it at what rate? 68 rupees. That means how much cash will go out? 68 rupees will go out to buy $1. So for $20,000, how much cash will go out? 13,60,000. Got it? Balancing figure is your SPL. So SPL account debit 40,000. This is one entry on gross settlement. But you already booked derivative financial asset previously that you need to write off. So the second entry will be SPL account debit to derivative financial asset. How much? 12,000, 12,000. Or if you want, you can club these two entries also. This is the entry for gross settlement. But mostly derivative mein it will be a net settlement wala case. Okay, so this is about derivative ka little drama. Yes, people? Yeah. Okay, I think there's one or two concepts remaining and that's pretty much it. Okay. Sir, if you have any embedded derivative, what to do? So what is embedded derivative? Embedded derivative means, sir, you have a normal contract. Normal contract means financial asset, financial liability, or even for that matter, non-financial assets. That is bundled with derivative. A normal contract and a derivative has been bundled together. Combo offer. Sir, how, sir? Sir, excuse me. Excuse me, simple. Okay. So let's say there is A Limited. They are there in India. Let's say there is another company B Limited. They are also there in India. A Limited is selling the goods to B Limited. Obviously, that means they'll bill. But the billing value is in dollars. Billing value is in dollars. Sir, both the entities are in India. That means they should have billed it in which currency? Indian currency. But they billed it in dollars. Now you check. Is this a derivative transaction? Normal purchase sale transaction. Correct or not? But this also has a derivative feature. Why? Sir, how much amount A will receive will be based on dollar fluctuation. And how much amount B will pay will be based on dollar fluctuation. Yes. So that means this becomes your embedded derivative. A normal contract which also has some derivative features. It's not full-fledged derivative because all the features of derivative will not get satisfied over here because initial investment and all will not be nil here in this case. So that's what we mean by embedded derivative. A normal contract which has some derivative or features. So first, now for accounting per se, you just check whether a financial asset has derivative features or financial liability or non-financial asset has derivative. If financial asset has derivative features, such financial asset generally will fail CCF test. So by default, they'll anyway be measured under FVTPL method. If it fails CCF test, you can't follow ACM or you can't follow FVTOCA. The only method for you is FVTPL method. That is the reason by default you do FVTPL method. And for derivative also, you will anyway follow FVTPL method. So no need to split the derivative and financial asset separately. Because here we have financial asset and we have derivative. No, should we split or not is the question. since anyway the contract is measured under FVTPL, okay, this financial asset is measured under FVTPL and derivative also is measured under FVTPL, no need to segregate them. You treat it as one contract, okay, like that. However, if a non-financial asset or financial liability has some derivative features, first check are they closely related or not. There's some features, we'll see. Okay, if it is closely related, then again you don't have to split them. You recognize full contract under FVTPL method. You don't have to split the financial liability portion separately, derivative portion separately. Treat them as one and account both under FVTPL method itself. However, if it is not closely related, check whether can you separate them. Is separation possible? If you say separation is not possible, then you treat it as one contract and account both of them under FVTPL method itself. However, if you say separation is possible, check how is post accounted. Post means your financial liability or non-financial asset. How is that accounted? If it is already accounted under FVTPL method, then no need to split, because even derivative under FVTPL, post is also under FVTPL. So what's the point in separating? Not required. However, you can separate it, but post is not accounted under FVTPL method, but under different method. Then you need to separate it. Post you'll account it as per the respective Ind AS, because here you have non-financial asset also, no? So other Ind AS may also be applicable. However, derivative you will follow FVTPL method. Okay, so how do we tell whether it is closely related or not? I've just given some examples here. Let's say one company, Wipro, is there in India. They're transacting with Infosys also in India, but the billing is in dollars. Sir, either the billing should be, or billing should have been ideally in rupees, but they have done it in dollars. That means these are not closely related. One party is in India, another party is in Euro. Okay, but the billing in dollars. Sir, at least the billing should have been in Indian rupees or in Euro, but they billed it in dollars. Again, not closely related. However, company is there in India and another company is US. Billing is in dollars. Now, this is closely related. Yes, no, because one of the parties there in US means the billing could be in US dollars. So hence, in these cases, you could say closely related, like that to identify. Okay, sir. All right. Then one last thing you need to remember is foreign currency embedded derivative separation rules. So if you have some foreign currency transaction with embedded derivative feature, how do you separate this? Okay. Or if you want to separate it, means how do you do it? So some rules for it. I've just given that we will apply. Maybe once I'll call it out, then we'll immediately apply it in one of the questions. Okay. The first thing, sir, the host, no, sir, you recorded at notional forward rate of the contract duration. Host is accounted. Host means original contract. Could be your inventory, PP, credit, or whatever it is. The host is accounted using forward rate of the contract term. If the contract term is 8 months, in the question they will say 8 months ka forward rate. If the contract term is 3 months, then they will, in the question, there will be something called forward rate for 3 months. Use that and do the host accounting. Host is convert, because this is foreign currency transaction, no? So you need to convert. So you will convert using forward rate for the contract term, which will be specified in the question. Okay. Second, no accounting for derivative on the contract date. On the contract date, you will not do any accounting because derivative will not have any fair value. Only options. Options will have fair value. Other than that, other derivatives like forward options, forward futures and all will not have any fair value. So no accounting is required. However, on the reporting date, okay, compare the forward rate with the forward rate of the remaining period, gain or loss. Okay, I think I'll better do a thing. I'll just check. I think these wordings looks a little bari. So let's do a thing. Let's directly take it up in question. So come to question number 89, everybody. Much easier to do that with the numbers, I think. Yeah, come to question number 89. Okay. So on 1st January 20x1, ABG Private Limited, a company incorporated in India, has entered into a contract to buy solar panels from AA Associates, a firm domiciled in UAE. One company is there in India, another company is there in UAE. So the billing should either be in dollars, or billing should either be in Indian rupees or the UAE wala currency. Okay. The due after 6 months. That means this, you have entered the contract now, but the contract execution will happen after 6 months. That is on 30th June 20x1. Price for solar panel is USD 50 million. Sir, they have billed it in dollars. So closely related or not closely related? Not closely related. So you have to separate it now. So how to do the separation? I'll give you some rules. The functional currency of ABG, that other company, is Indian rupees and UAE is dirhams. Okay. At least the billing should have been in Indian rupees or dirhams. Here it's neither dirhams nor INR, but it is in dollars. Hence not closely related. So you need to split. The obligation to settle the contract in US dollars have been evaluated as embedded derivative, which is not closely related. They only told. Okay. Spot rate on 1st January. The day you enter in the contract was 60. 6 months forward rate. Remember this? 6 months forward rate is $1 is equal to 65. Spot rate on 30th June is $1 is equal to 66. You need to analyze. Okay. So let's do that. I'll learn it with the help of journal entry only. First, on 1st January, so you have just entered into a contract. You will purchase solar panel. Have you already purchased? No, purchase will happen 6 months later. So you can't pass any journal entry for purchase because it will be executed in future. Okay. What about derivative? Sir, since you have entered into you build it in dollars, how much you will pay or how much you will receive is based on dollar fluctuation. So this dollar fluctuation acts as a derivative for you. Okay, that fluctuation is accounted as a derivative in our books. Okay, here you have not entered into any derivative contract, but since you build it in dollars, how much you pay or how much you receive is based on dollar ka fluctuation. Hence, that dollar ka fluctuation only is recorded in our books as the derivative. Okay, fine. Okay, so they've given 6 months for forward rate over here, and forward contract, we know that initially on the contract date, will it have any value? So that means derivative accounting also is nothing on the contract date. Okay, next on 30th June, you have to pass purchase, right? You have to purchase the goods. That we are calling it as host. What did I say for host? Host is always accounted under contract duration ka forward rate. Here contract duration is how many months? You entered in 1st Jan, settlement is after 6 months. The contract duration is 6 months. So do you know 6 months ka forward rate? Yeah, 6 months ka forward rate is 65. How much is your purchase price of solar panel? 50 million. Okay, 50 million and $1 is equal $50 million and $1 is equal to 65. So 50 into 65 is how much? 3250 million Indian rupees. Yes. So what's the journal entry for purchase? Purchase account debit to financial liability creditors 50 into 65, which is 3250 million or 325 crores if you want to call it out. Okay. So that is one. Okay. Then on 30th June, now derivative is there. Checks. Excuse me. On 30th June, what is the dollar rate? 66. 66. Now, this is your notional accounting because you have not entered into any derivative contract at all. This is your notional accounting. What it says is, sir, if you had entered into a forward contract, you would have entered first only. Listen to this carefully. If you had entered into a forward contract, you would have entered on the first day only. If you had entered into a forward contract, now you have to purchase dollars, right? Because if you have to buy solar panel means you have to pay, and you have to pay in US dollars. If you have to pay in US dollars means the Indian entity first has to purchase US dollars and they have to pay, right? So if you had entered into a forward contract, no, $1 you could have purchased by paying 65 rupees. You would have able to purchase $1 by paying 65 rupees. But have you entered into such forward contract or notional? You have not entered. But now the spot rate on 30th June or $1 US dollars on 30th June has become 66. Now to buy $1, you have to pay 66 rupees. If you had entered, listen to this very carefully, this notional accounting. If you had entered into a forward contract, you would have purchased the dollar just by paying 65. But did you enter? No. Now the rate has become 66. To purchase $1, you have to pay 66. That means you are in happy scenario or sad scenario. If you had entered, you would have paid only 65. Since you have not entered, now you have to pay 66. That means there is a 1 rupee loss you are facing on $1. Yes. And what is the contract value? $50 million. That means what is the total loss you're suffering? 50 million. Okay. Is it the actual loss? No, there's a notional loss you're accounting. And if it's a loss, you know, what do you book? Derivative financial asset or derivative financial liability? Derivative financial liability. So the journal entry will be SPL account debit to derivative financial liability 50 million, 50 million. So is this an actual loss or notional loss? This is a notional loss. Okay, sir. All right. 30th June is the settlement date. Sir, if you are actually entered into a derivative contract, it would have settled. Maybe on a gross basis or on a net basis, settlement would have happened. So is this an actual derivative contract or notional accounting? So notional accounting. So what do you do is, whatever is the derivative financial liability you have now, you transfer it to host account. Host here refers to financial liability. This derivative financial liability, you transfer it to creditors account. Because this is notional accounting. So there is no settlement for this. Normally in derivative, there will be a settlement either on a gross or on a net. But since this is notional, right, and the contract term has ended, so the only way for you to close out this derivative financial liability is transferred to host account. So it has credit balance, this DFL. How do you close out? DFL account debit to financial liability creditors, whatever is the balance, 50 million, 50 million, like that. Okay, that means creditor balance will become from 3250, it will increase by 50 and it will become 3300. Okay, now on 30th June, suppose you're making the payment to that creditor. What is the entry? You're making the payment means obviously whatever is you already know. I think basics of foreign we already know. So all settlements are recorded at settlement date ka spot rate. Whenever you do any settlement, you have to do it at settlement date ka spot rate. So you have settled at 30th June by chance. They have not given. By chance you are paying money to this foreign creditor on 30th June. So on $1 you have to pay how much? 66 rupees. And how many dollars you need to repay? 50 million. So 50 million into 66 is how much? 50 million into 36 is 3,300. Creditor balance is also 3,300. You have to pay also 3,300. That means all the account will get closed. This way, the accounting will happen. In this problem, there's not much significance because you're doing this accounting only once on 30th June. Sometimes they may bring in another period of 31st March also in between, right? So there the play, this whatever gain loss, no, if they want to increase this question size, no, they'll increase the period. They'll make forward contract as 1 year. Okay. Then they will say first quarter ended, this is the spot rate. Second quarter ended, this is the spot rate. Third quarter like this. That means you will have to go on booking the loss. All these are notional loss. Go on booking the notional loss. But since there is no settlement, whatever is the value of derivative financial liability or derivative financial asset, whatever is the case may be, here it's a case of DFL, that will be transferred to host account. Okay. And if you are settling the host on the same day, this I've assumed, okay, they have not told in the problem. If you have settled means the creditor has a balance of 3,300 and settlement also has to happen at 3,300 only, because on the settlement date, exchange rate is 66 and you have to pay 50 million. That means you will pay 3,300 and settlement will be done. Okay. So this is about foreign currency embedded derivative. Okay. So this question also I've done through. I think all the questions we have gone. I'll just look at the concept just to be sure once. Maybe one more thing I did not mention here, sir. Sir, if you have property, plant and equipment, inventory, intangible asset, prepaid expense, all these are not financial assets. Financial asset means something to do with cash. Like if you own debtors, you have a contractual right to receive cash. You don't have to do anything. If you have to collect, if you have sold goods to debtors worth 1 lakh, if you are showing debtors in your books worth 1 lakh means you will receive cash of 1 lakh. Okay. But if you are showing PP worth 10 lakh in your books, if you're showing PP 10 lakh worth in your books, will you receive cash of 10 lakh? No. In order to receive cash, you need to sell the property, plant and equipment. By holding property, plant and equipment, you will not get cash. You have to use it or you have to sell it. You have to do something else. That's the reason your property, plant and equipment, investment property, intangible assets, all these are not financial assets. So you can't bring them under Ind AS 109 accounting. Same goes for prepaid expense also. If you have paid any prepaid salary to your employee, you have a contractual right to receive what? Service. If you already paid some advance salary, you have a right to receive service from employee and not cash. That's the reason these are also not financial assets. Okay. Yeah. So all this we have covered. Yes. Okay. Impairment. Sir, impairment, there is impairment of financial assets. You don't apply Ind AS 36. Okay. Impairment, no, sir, it has a lot of drama. But just know two things. Impairment has, you need a lot of data, and for that data, we are not equipped enough to find out that data. So all this data will be given to us directly in the question. So to get impairment loss, it is very, very simple formula, sir. 3 components you need to multiply. They'll give the amount of financial asset. Impairment loss will be applied only on financial asset, not financial liability. And on financial asset measured at FVTPL method, we don't do impairment, because if you're using FVTPL method, anyway, you will value it at fair value, right? And the gain or loss anyway goes off to SPL. Impairment loss also goes off to SPL. So that's the reason if any financial asset is measured under FVTPL method, such assets, you need not do impairment check. Okay. All right. So only 3 things you need to multiply. One is the amount, and they'll give you something called LGD percentage, loss given default percentage. Let's say you have an amount of financial asset who is measured under FVT OCI worth 10 lakh. Sir, entire 10 lakh will be lost. No, it may be possible that only 30% of this may be lost. That is nothing but loss given default percentage, which will be given to you in the question. This is based on past experience. You need to estimate. That's the reason, since all these are estimates, no, we can't do all these estimates in examination. So they'll have to give out all this. Okay. So we are estimating that what 3 lakh will be the loss. And they'll also give you something called probability of default, POD percentage. That could be, let's say, 1%. That means impairment loss is simply multiplication of these things. So this will be what? Multiplication of all this, you'll get 3,000. This impairment loss, you transfer it off to P&L. Amount multiplied by LGD percentage multiplied by POD percentage. Okay. This probability of default either could be a lifetime POD or it could be a 12 months POD. For your debtors and short-term assets, we use lifetime POD. Okay. For other assets, all right, or for other assets which is credit impaired or there is a significant risk, those financial assets which has significant risk and some debtors and all, we use lifetime POD, because generally debtors means you will receive within 12 months only, you know. So their lifetime only will be lesser than 12 months. For short-term assets and debtors and those assets which has significant risk, we use lifetime probability of default percentage. For other assets which are normal, we use 12 months ka probability of default percentage, which they will specify in the question. So these 3, if you multiply, straight away you will get impairment loss. So if at all they're testing impairment loss, all the factors will be given. Just you need to multiply. Okay. When you do theory, it looks very things. But all this data in exam, they have to give you. So impairment loss in exam relevance is very, very low significance. Okay. So that's about that. Okay, so these are all okay. The hedge accounting, the last one maybe. Okay, I'll not take more than 5-10 minutes. Hang on. Sir, hedge accounting. So what is this hedge accounting, sir? Sir, in hedge accounting, there will be 2 instruments called hedged item and hedging instrument. Hedge item is that item which is exposed to risk. Hedged item is that which is exposed to risk. Hedging instrument is a derivative contract which you have entered to cover the risk. Okay. Like, so let's say you have issued some foreign currency debentures. You wanted to issue some debentures. Okay. Instead of issuing it in India, you issued foreign currency convertible bonds, FCCB, which we call it, right? Foreign currency convertible bonds. Because you thought if you issue this in foreign, if you had issued bonds in India, the interest rate, let's say, is 10%. But on FCCB, let's say the interest is only 7%. So you thought less interest, that's the reason you issued FCCB. Okay. But since it is a foreign currency convertible bonds, you may have to pay everything in dollars, or you'll receive everything in dollars, right? That means how much cash you will receive, no, is subject to exchange loss, correct? It's subject to exchange fluctuation. Some months may receive more, some months you may receive less. That means there is always an exchange risk. So how much cash you will get is always subject to risk, right? So this bond is your hedged item, meaning on this bond there's an exposure of risk. That we call it as hedged item. Hedging instrument is normally to cover this risk, we enter into a derivative contract. So that derivative contract, we call it as hedging instrument. Okay. So what is this hedged accounting? Why is it necessary? Sir, bond means obviously you would be doing ACM accounting. If you have issued the bonds, so this is a financial liability. So you would be doing ACM accounting because it will satisfy business model and contractual cash flow test. But hedging instrument is your derivative contract. On derivative, obviously you will follow FVTPL method. Obviously you are able to see some mismatch here. Because only if hedged item is there, hedging instrument also will be there. If hedged item is not there, hedging instrument also will not be there. Correct? Because hedged item has a risk, and to cover that risk only hedging instrument came in the first place. So, but if these two go hand in hand, but one you are doing under ACM accounting, another one you are doing under FVTPL accounting. So there is an accounting mismatch. Hence they introduce something called hedged accounting. So what does hedged accounting say is there are three types of hedge that you can enter into. One is cash flow hedge, another one is fair value hedge, another one is hedge of net investment in foreign operations. Okay. I'll tell you, I've already done, there's one question on this, I think an MTV problem or something. It's already available on YouTube. You can watch that. I'll just give you a quick overview. What is this hedge accounting all about? It's a simple one only. So what cash flow hedge says is there is a cash flow variance risk. So how much cash flow either you will receive or you will pay, no, that is subject to risk. To cover that only, you are entering into some derivative contract. Hence the name cash flow hedge. Okay. So what this cash flow hedge accounting simply says is, excuse me, sir, all your notional loss, obviously when the moment you enter into a derivative contract, you have to do FVTPL accounting, correct? No? So that means every reporting period you have to go on measuring the fair value, and there will be some fair value gain or loss. All this fair value gain or loss, no, is just notional loss. Actual loss you will only get to know at the end of the period, correct? No, on the settlement day. So what this cash flow hedge says is all the notional loss, no, don't transfer it to P&L. Normally on derivative, you transfer all this loss to or loss or gain to P&L. Cash flow hedge, what it says is all this notional loss, you transfer it to OCI. And the name of that OCI is cash flow hedge reserve, CFHR. Okay, you transfer all this notional loss to cash flow hedge reserve. You keep doing this. On the settlement date or once the contract is settled, okay, you keep passing this entry. If the contract goes on for 1 year, means till 1 year, whatever is notional loss is there, go on parking that is, don't transfer it to P&L, park it in OCI called cash flow hedge reserve. Once the cash flow or contract is settled, from cash flow hedge reserve, transfer it off to SPL. On the settlement date from OCI, you transfer it to P&L account. Till then, let it be in OCI itself because these are on notional loss. Okay, let your financial statements not get impacted in a much way. Is this particular accounting a thought process? So it's very simple. You park all this notional loss in one OCI, and name of that OCI is cash flow hedge reserve, and the settlement date from cash flow hedge reserve, it will be transferred off to P&L. It may get transferred to P&L in different names. In one of the problem, it has got transferred to P&L in the name of revenue. That's okay. But ultimately, this cash flow hedge reserve will get transferred off to P&L account. That's all is the summary of this particular accounting. Okay. All right. Hedge of net investment foreign operation is the same thing. Okay. So if you have, let's say, a foreign subsidiary, you know, obviously how much the value of the investment also varies, right? So this is also the same thing. Instead of transferring that loss to cash flow hedge reserve, you transfer it to FCTR. This is also OCI only. Instead of transferring it to cash flow hedge reserve, you transfer it off to FCTR here. All the notional loss, you put it in. The investment, no, going up and down, investment value is going up and down. That investment value called loss or gain, you park it in FCTR. That means when will this FCTR, sir? Sir, FCTR is basically a reclassifiable OCI. Meaning the moment you sell the, obviously you may at some point of time sell foreign subsidiary holding. So if you have lost control over the foreign subsidiary, then if from FCTR, it will be transferred off to SPL. Okay. Till then, that particular balance will be accumulated in FCTR. Till you have control, all the gain loss you will accumulate it in FCTR. Once you have lost control over subsidiary, from FCTR, you transfer it off to P&L account. That's what happens in hedge of net investment in foreign operation. Now, what is fair value hedge? Fair value hedge is the value change risk you are doing. Okay, there's some value change risk. So to cover that, you're doing some derivative accounting. What this says is, what did cash flow hedge reserve say? Transfer all notional loss to OCI. Fair value hedge says nothing doing, transfer both ka loss to P&L only. The gain loss on hedged item and the gain loss on hedging instrument, both ka thing you transfer it to P&L only. Ulta. Cash flow hedge reserve said you transfer it to OCI. Fair value hedge will say simply transfer everything to P&L account. Okay. All the financial asset ka, you gain loss, hedging hedge item and hedging instrument ka loss, you transfer it to gain loss, you transfer it to P&L only. Except one case. Sir, if you have any equity instruments, normally sir, equity instruments, if you, excuse me, if you purchased, let's say Infosys ka financial, if equity shares, so it's a financial asset. If you purchased equity ka, Infosys ka financial share, equity shares means it's a financial asset. On this financial asset, so cash flow test will fail. Why? So if you purchased another company ka equity shares, right? Will you get some dividend every year? No. Other company may give dividend, they may not give dividend. Will you get your money back? No. Company has no obligation to repay you. It's a permanent capital. Yes, no. Infosys has no obligation to repay you, dividend also and money also. That means contractual cash flow test fails for equity financial asset. If you purchased equity shares of another company as an investment, it fails CCF test because neither you will get your principal back, you may not get your principal back, and you may not get periodic interest or dividend also. Hence, it fails CCF test. So, hence, equity financial asset, no sir, by default, you have to measure it under FVTPL method only. The default is you have to go for FVTPL method. But one irrevocable option is given. Irrevocable means you cannot cancel it. One irrevocable option is given where if company wants, only if company wants, they can measure such equity financial asset using FVTOCI method. If company wants, they can measure this equity instrument at FVTOCI method. Okay, this is irrevocable. That means once you choose this, you have to stick with this. You cannot back out of this. First year, you can't follow FVTOCI method and then say I will follow FVTPL method. No, once you have come to FVTPL method, it is irrevocable. Once you have come to FVTOCI method rather, it is irrevocable and you have to stay in that category forever. Till you sell that investment, it will be in FVTOCI category only. Okay, so if you are having FVTOCI equity instruments, on that if you are doing any fair value hedge accounting, okay, so obviously this is your hedged item and for hedging instrument will be your derivative. If this has a risk means to cover that risk, you will enter into derivative contract. But since this option is irrevocable, in this case, what you do is gain loss on both these things, you will transfer it to up to OCI because this is irrevocable. No? You cannot transfer it to P&L at all, right? Hence, there is a restriction. Hence, they said the gain loss on derivative also and gain loss on equity also, you transfer it to OCI. On all other previous things, hedged item ka gain loss, hedging instrument ka gain loss will be transferred off to P&L. Only in this irrevocable option, both ka gain loss will go off to OCI. Okay. Yes, people. So with this, all the components or the major concepts of financial instruments we have covered. So thank you for your wonderful patience. It's been almost 3 hours. So you've been sitting very patiently. So glad to know that. So let's take about a half an hour break and then we'll take up the next topic. Thank you.